Okay, yeah, thank you very much, Fiona. Thanks, guys, for sticking with us. It's the joys of lockdown meetings.
Chair, I can confirm that we are now live on YouTube.
Thank you, Fiona. Good morning, everyone. Thank you very much for joining. This is the first virtual pension fund panel committee meeting, and welcome to any members of the public who are watching through the council's YouTube channel. I'm Mark Bainan, chairing this meeting today. Can I just remind people to, turn off mobile phones, other devices that might cause any distraction in the background. Can I ask people to stay on mute while they're not talking? Obviously, yeah, just to familiarise yourself with the mute button, so you can unmute yourself when you contribute to the meeting. This meeting is being broadcast live, as I said, on the YouTube channel. A copy of the recording will be available on the channel shortly. After the meeting, members, if you do wish to speak during the meeting, if you can indicate through the chat function, if you just type in your name, we'll be monitoring that, and I think that would be, well, hopefully that will be the best way of kind of organising the conversations. So the pension fund panel, for those who are watching on YouTube, there's 5 councillors and 4 non-voting members. We also have a number of officers present, whose cameras will be switched off unless they will be kind of talking to the committee on any issues. The council will go around the room, as it were, virtual room, just if people could introduce themselves briefly. So we've got myself, the chair of the committee, Councillor Dennis Goodship as vice chair. Can you just say hello, Dennis, introduce yourself? Thank you.
Hello, it's Dennis Goodship, councillor for Tarbeth and Hook Rise.
Thank you, Dennis. We have Roy Aurora. Roy, if you can just say hello and introduce yourself.
Good morning, Chair. Yes, sorry, I was on the wrong. Yeah, thank you.
Okay, great, thank you. Jason Ha.
Good morning, Councillor Jason Ha here. Thank you.
Thank you. And Councillor Alison Holt.
Good morning, Chair. Yes, Alison Holt, Councillor Alison Holt from Surbiton Hill Ward.
Thank you. Got one non-voting member, Chris Coke.
Hello. Chris, yes, I'm Chris Coke. I represent the retired members of staff at RBK.
Thank you very much. And last but not least, we have Daniel Carpenter, our investment advisor. Daniel, can you hear us okay? Can you introduce yourself?
I can. Thank you, Chair. Yes, good morning, everyone. Daniel Carpenter of Aon.
Thank you very much, guys. And we have a number of officers here in attendance who will be helping out with the presentation and reports during the meeting. First item on the agenda, apologies for absence. Karen, do you have any apologies for absence, please?
We have apologies from I beg your pardon, from Leslie Diston.
Thank you very much. Declarations of interest. Can any members, if any members have any pecuniary interests or other non-pecuniary interests relevant to items on the agenda, please can they declare those through the chat function now? Okay, I will take that there are no declarations of interest. Thank you. Can we confirm the minutes held at the last meeting back in 11th of February? Confirm, yeah, is everyone happy that we approved the minutes? Nod of the head, or yeah, no one's objecting, so I'll take that as a yes. Right, so the first item on the agenda is, or the main substantial item on the agenda is the pension administration update. David, hello. I'll pass it over to you, please, David. Thank you very much.
Thank you, Chair. Just going through the report then, just give you a brief summary. The first issue we pick up there is our response to the COVID-19. Like it says there, consistent with many other businesses, we're all working now remotely as a team, which does appear to be working pretty well for the most part. So there's been very little impact on the service from that perspective. It is important, I think, that we've had very minor issues about sort of screen equipment and so on, but they're all pretty much resolved. People are carrying out workstation assessments at home, so that's as I say, that's all working very well. We do have 1 or 2 individuals visiting the office once or twice a week just to deal with some of the hard copy post in and out of the section, but other than that, it's all working relatively well. We did issue and have been issued some comprehensive guidance from the LGA, which we passed out to employers. We did also issue a frequently asked questions document to all our scheme employers, and a copy of that also was sent out to all our pensioners to address. There was a few issues around pensions there to address any concerns that they might have. We've mentioned in here that it hasn't created any additional pressure in any real sense for us. That was sort of an anecdotal remark. I did check the statistics, and so over the period of March to the 4th of June, we did have an increase, and this is, to be fair, I've only run these figures across Sutton and Kingston, but we did have an increase of 20% in the number of deaths for the same period last year. Having said that, I don't know quite how much that tells us, because I mean it's probably not a big enough, over a long enough period to know whether that is significantly higher, and it's certainly not in any way significant in terms of us needing to adapt processes. In number terms, we're talking maybe an extra 20 cases than we have received for the same period over those couple of months from last year. So it's easily manageable within our section. In terms of monitoring and complaints, pleased to say there haven't been any new cases either via IDRP or cases referred to the Pensions Ombudsman. Following the completion of the valuation, we've issued new employer contribution rates to all of the scheme employers, and they're now being implemented and paid. Around the issue of annual returns, at the time that this was written, we had received 48 of 50 annual returns that were expected for Kingston employers in the fund. I'm pleased to say that that's now complete. We've got all of those back now. If any, those that were late, the pensions admin strategy does allow us to issue a fine, but we didn't feel that we needed to in any of these circumstances this time around. Pensions increase, so this is the annual increase that we apply to both pensioners and deferred members of the scheme. That's all successfully been implemented. Picking up then on the pensions administration software, we've continued to work very closely with Civica, and we're about to, on Monday of next week, introduce a new means of distributing workloads amongst the team. Slightly delayed, just to 1 or 2 technical issues that we needed to resolve before that was to be implemented. You'll note there on the report that it does say that it would be implemented in June. We're very slightly going to go into July. The reason around that is that at the moment the distribution of work is on an alpha split basis. What we're looking to do is it will be driven by a priority basis. So the most urgent pieces of work will be looked at first. So that's something that we're working on at the moment. We've introduced a new policy around the recovery of overpayments. This is principally, although not exclusively, around where members of the fund have passed away and the pension payments have continued beyond the date of death. This is really just to try and make that process a lot quicker and a lot easier. What will happen now is that an invoice is issued. That makes it sound rather harsh, but it is being dealt with sensitively given the sort of case types. It just makes it easier then to make the claim on the estate of the deceased. Previously, I think there were some practices going on where the ongoing pension to a spouse or so on was being debited, which isn't strictly correct. So we've tried to address that, and as I say, we'll now be issuing a invoice to the estate of the deceased pensioner. Where it is in overpayments, although fairly rare, do happen where pensioners aren't deceased. then it's a slightly different approach there in that we can then debit off the ongoing pension and so on. It's just coming to a reasonable arrangement with the individual. So that's what we're doing there. Around the performance stats of the team, the service standards have improved across all of our priority levels. If you look into the table there, you can see that on the priority 1 cases, we're at a compliant rate of 94% for the month of April. Last year's average was at 76, so we are working hard to continue that. And to sort of reaffirm that, this new means of work distribution will help with that by being done on a priority level. The open processes have fallen and are now at their lowest for some time. And you've got a breakdown there over which are more up to 3 months overdue and more than 3 months overdue. Those that sit within that period that are more than 3 months overdue are typically deferred benefit cases, which form the bulk of the backlog of work. And I'll come on and just speak about that in just a second. We've got the pensions online take-up numbers again. We'll probably look to do something again with that in August, when we issue annual benefit statements. So in order to improve those registration numbers again. And then looking at the next table there, you've also got the compliance broken down by priority level. So the year to date, we're at 94 on the priority 1, 90 for 2, and 74 on priority 3 level cases. We have looked to have a real focus on those priority 1 cases, and that does seem to be working. I think what we're conscious of now is that we have got the issue of the higher volume, lower priority level cases, so the priority 2 and 3 cases. We're looking to address that, so we've just recruited a temporary officer to address the outstanding deferred benefit cases, so they will be working exclusively on those. And in addition to that, we are recruiting at the moment for 2 additional apprentices into the team, which again will help with the lower priority level casework, allowing more senior officers to focus on that priority 1 and other projects. So that's what we're doing at the moment. You've got a breakdown of the outstanding processes again there by priority level, but I'm happy to take any questions. I think there was Councillor Holt, did you have a question? Sorry.
Yes, thanks very much, David. And sorry, it sounds like you've kind of coped with obviously the unusual circumstances very well, and still make progress on with the service levels. So that's good news. Thank you. Yeah, Alison, you had a question, I believe.
And I just wanted to echo the fact that it was good that you have put in place the measures for the COVID-19. I think that the having the FAQs for members is good. So that and the other things that you put in place, so that was good. For me, it was just that you mentioned about the Civica, and it's just something that I've sort of been aware of over the time I've been on the committee, that there has been some staffing issues, recruitment and retention of staff. So I just wondered what the impacts of that has been, and then linking in with the Civica, you said about changing priorities. I just wanted to make sure that whilst there's the priorities for the high ones, that you're not missing off the ones that the ones at the bottom just keep on falling.
Sure.
So absolutely around that.
So I mean, to address the recruitment issue first, so we up until Christmas we did have a sort of technical officer that dealt with systems, if you like. Following his departure, we have looked to work rather more closely with Civica to try and fill that void, for 2 reasons really. One, for the very basic reason of just improving that our use of and knowledge of the system, but I think probably more key was around the issue around the inability and the likelihood of being able to recruit someone with both the pensions experience and the systems experience. And we just felt it just wasn't going to happen. So we, as I say, we're working a lot more closely with Civica now to try and improve that service and do it in that way rather than having someone within the office. Around the priority levels and how we're attacking that, I completely agree with you in that whilst we've had a focus on the priority 1 and improving our compliance in processing what are by definition the most important cases, I agree that it's important that we do still keep an eye on the lower priority casework that does get addressed. And as I say, that's why we've recently recruited a temporary officer to address the deferred benefit cases, which, if I'm being brutally honest, probably form a minimum of 50% of the backlog of work. So they will work exclusively on those cases to try and get rid of those. And as I mentioned, again, recruiting 2 new apprentices that we can skill up and train in-house, again addressing that recruitment issue of being able to get experienced people, so instead sort of growing our own. But again, where their main focus will be initially will be on that on the lower priority but typically higher volume casework that we've got. The other thing that I probably would mention on that is that, you know, that the system that we're going to operate, essentially how it will work is that members of the team will work from what we're describing as a drip tray that will just distribute work on a coefficient between the priority of the case and the length of time for which it's been outstanding. What we will be doing is separating that with effect from Monday from all cases that are existing as of Sunday night, and we will then address that manually so you should see then a backlog number that will just decrease, that can't be added to. And what it will allow us to do is to both make an assessment of have we got enough resource to cope with the ongoing workload, or do we need anything additional? So it will very much highlight that, in that we've separated out the backlog as at that date and then the ongoing work. So how I would hope that it will work is that we'll have a number of officers working from that drip tray approach, and we'll have someone else, maybe one or two others, working from that backlog. Once that backlog's gone, then again we'd reassess again and see what position we're in there. But that's how we're trying to sort of attack it from both ends.
That's fine. That's a good, excellent answer. And so it's good to hear that you are thinking of that. That was my concern, is that whilst the priorities are good to do, it's the other stuff that then gets
absolutely.
So that's good to hear that you're thinking of that. Thank you.
Sure.
Thank you very much. Thanks, David. Does anyone else have any questions or comments to make about the report? No? Okay.
Sorry, Chair. One thing I probably also should just mention in passing, it's not in the report, but this will be my final meeting with the panel. I'm actually moving on to another fund next month, so I just thought I'd mention that. My deputies will attend in my place in the short term. There is a new appointment of a new pensions administration manager who's expected to take over in probably early October, but there will be a short interim period where the deputies will sort of fill that gap. But I just thought I'd better make you guys aware.
Okay, well, sorry to hear that, but well, good luck.
Thank you very much.
And yeah, well, thanks for your contributions to the panel up to now. So yeah, well, thank you very much. You're more than welcome to stay for the rest of the meeting, but we won't be offended if you decide to, you've got other things you need to do. But yeah, I wish you best of luck with your new challenge. Are we happy to note the contents of the report? Anyone who objects, raise your hand or type in your name now. Okay, so I think that's, yeah, we can note the contents of the report. So thanks very much, David, for that. So next item on the agenda is the pension fund valuation performance, and also talk about the impact of COVID-19. Obviously, that's having a big impact on all areas of our life, including the pension. So I'll be passing over to Tamara Burnell to take this segment. Thank you, Tamara.
Thank you, Chair. Good morning, everyone. Apologies for my internet connection problems earlier. I've got an unstable connection, apparently, but hopefully it will hold out for the rest of the meeting. Yes, the 3 months to March 31st were obviously pretty difficult ones for investment markets, particularly the last couple of weeks of March. And the fund decreased in value by 11.5% over that quarter. However, as you're all aware, we're investing for the long term here. And so short-term fluctuations in performance are much less important. And I would note that the fund is only down around 3% year on year. It's also worth noting that a significant recovery has taken place in the 2 months since the quarter end, and most of the funds that we're invested in have recovered perhaps 3/4 of the fall that they had in March by the end of May. It does vary significantly by fund. it has been quite interesting to note the variations in performance between the different managers and the different styles. In particular, Schroders and the CQS London Civ Fund had particularly difficult periods in March, and the Schroders Fund continued in April to struggle as well. So I'm sure that'll be one that you want to consider as part of the investment strategy review going forward. In light of the significant market movements at the end of March, we asked Aon to give an opinion on whether the fund should look at any rebalancing, whether it had fallen outside any of its rebalancing parameters, and also to consider whether the investment beliefs that you'd considered at your last meeting were still valid in the light of the very significant changes in asset prices. I'll let Daniel speak to that in a minute. And then finally, we also, the pensions regulator sent out guidance. They were sending out guidance daily, actually. It was quite overwhelming, the amount of emergency guidance that pension funds were receiving over this period. But one of the pieces of guidance was that pension funds should be looking very closely at their cash flow. And I've included some of the cash flow information in the report. We're in the fortunate position that we're sort of cash flow positive from contributions from members at the moment, and for the next 3 years. We also received a prepayment of deficit contributions from the council, which added to the cash position. We've had no issues with cash flow. We haven't so far had any employers say that they're going to struggle to meet their pension contribution payments, although obviously that's something that we will need to watch for the future. But for now, we haven't experienced any significant cash flow issues that we need to report to you. Perhaps Daniel, do you want to add to the comments on the need for rebalancing and investment beliefs?
Thanks, Tamara. I was going to pick all of that up as part of the deck of slides that I've got that's in the pack. So happy to take those now, unless there's any further comments you wanted to make, Tamara.
No, nothing more from me.
Okay, thank you. Panel, I'd like to just turn to a deck of slides that I've put together entitled Market and Fund Update, which I believe is page B12 in your packs. And just to provide a bit of background on this, as Tamara's just highlighted there, very conscious that we went through a period of quite significant market turmoil. And as a consequence, we thought it'd be helpful to spend some time just actually looking at the market impact, as well as the impact on the fund's assets, both during that period of turmoil in terms of the quarter, but also post the quarter end as well. And then, as Tamara's highlighted, what I'll also do is touch on some of the asset allocation and strategic considerations for the fund, particularly in light of the upcoming investment strategy review exercise that's going to be taking place. So if we turn to those slides and start with the market impact. So this is slide B15. A few sort of headlines there that you can see. We've really kind of experienced quite a significant period of turmoil there. A lot of increased volatility over that period, particularly over the latter half of February and early March. And there's sort of a continued period of real uncertainty in markets. In terms of the sort of extreme moves, we saw quite a significant fall in equity markets. They fell quite sharply over that latter half of the first quarter. And we also saw bond yields fall quite sharply. And at the same time, credit spreads widened considerably. So some quite extreme moves in market. And I'll put a bit of context around that when I go through the individual asset classes. But it's also important to emphasize that in that sort of stressed environment that we also saw quite a significant drop in terms of market liquidity. And that's important because in those sort of periods where you see that drop in liquidity, you see quite an increase in terms of transaction costs involved in terms of any trading. So in that sort of period of turmoil, you wouldn't want to be trading significantly in terms of your portfolio. And again, it just reinforces the message that Tamara's just highlighted there around the positive cash flow position that you stood in, therefore not having to incur any significant transaction costs during that period. Now that was the period really during the first quarter. I'm conscious that more recently and during the months of April and May, we saw quite a big bounce back in terms of markets, to a certain extent boosted by that sort of the signs of a sort of flatter trajectory across major developed economies in terms of the virus, but also really on the back of some quite extreme measures taken by global governments and central banks, really with a view to trying to sort of support economies and take some quite extraordinary measures. And moving on to slide B16 there, entitled Central Bank Actions, we saw quite unprecedented quantitative easing measures taking place, particularly by central banks. We'll all be quite familiar with what's happened in terms of the UK. We've seen 2 interest rate cuts in the UK. We've seen similar measures taken in the US. But I think what's been quite extreme is some of the statements that have been coming out by central banks to really support economies. And I'll pick out a statement made by the US Federal Reserve on the 23rd of March that basically said in not so many words that the bank would do whatever it takes to support economies and normal market functioning given the pandemic emergency. And that was a very strong statement that was made that really kind of had quite a boost to markets in that sort of last period of March and going into April and May as well. So some quite extreme moves and actions taken by central banks. If we now sort of turn to have a look at what impact that had at an asset class level, so B18 here in terms of equity markets, I mentioned earlier that we saw quite a sharp fall in equity markets. If you actually look back to the sort of point in terms of the highs in the middle of February, to its worst point, we saw falls in excess of 30% in terms of equity markets. So quite extreme levels. But what was particularly noticeable was the speed of the falls. And you can see a chart there on the right-hand side of that slide on B18 that really just tries to emphasize that point. And what that's trying to show is the different bear markets that we've seen over time. And we think of a bear market being a market fall in excess of 20%. And what we saw was that bear market that we just experienced was one of the most sharpest and quickest bear markets in history. So the fall in excess of 20% in equity markets happened over a period of 16 days. So quite an extreme period in terms of that market fall, but over a very, very short period of time as well. Now, I mentioned that obviously equity markets have recovered since then. And again, to put some numbers on that, if we look at the position over post the quarter end, so since the 31st of March, equity markets are up about 18% in terms of sort of global developed markets, to give you some sort of context. So there has been a good level of rebound post quarter end. And really what I wanted to highlight is to emphasize is that sort of end of March position really is quite a low point in terms of the position, particularly around equity markets. But at the same time, want to emphasize that a lot of uncertainties remain, a lot of risks remain quite high out there, and will continue to kind of remain quite high throughout this crisis period. So hopefully just giving you a bit of a feel there around equity markets and the position during the first quarter and post-quarter end. If we now turn to sort of have a look at the impact in terms of our equity managers, you may remember we have 3 active equity managers that form part of our portfolio. Again, just to give you a few of the headlines here, we saw significant outperformance from one of those, Columbia Threadneedle, and that's been a longer term picture there as well. We saw some outperformance over the quarter and 12 months from our mandate with Fidelity, and we saw underperformance from Schroders over the quarter, and again that's continued longer term. Just as a reminder, in terms of those 3 managers, the mandate with Fidelity is very much a core mandate, uses sort of bottom-up stock selection, and we have quite a diverse portfolio of holdings there. So I think it's currently about 430 stocks. But as I've emphasised, some strong recent performance, while conscious that longer term the numbers have been more in line with the benchmark. Threadneedle is a manager where it's a very concentrated portfolio with a tilt to sort of growth investing, growth style, and that has done extremely well, not just in terms of the last quarter and 12 months, but longer term as well. And then, as I mentioned there, the final mandate, Schroders, significant underperformance before, but this is a manager that has it's a quantitative approach, but with a value style, value tilt. And value as a style of investing has very much been out of favour in the market and faced some real headwinds, particularly in recent years. One of those has been the environment that we've been in around lower interest rates, which really hasn't rewarded those sort of longer term stocks, such as technology and the sort of related sectors. Those are the stocks that have done particularly well, and it hasn't been helped by the stocks in terms of the ones that are more focused on shorter term earnings, which are really kind of well reflected in terms of value indices. But again, this is an important aspect when we come into the strategy review to look at the different mix of styles that we have within our equity portfolio. Turning to the bonds as an asset class, we saw an environment of turmoil, and typically in those types of environments, we typically see that sort of flight to safety, the flight to sort of safe haven assets that the bonds typically represent. As a consequence, bond yields fell and really fell to sort of record lows. But at the same time, we also saw credit spreads widen quite considerably, although I'm conscious that they've now come in a bit. And as a consequence, again, if we think about different strategies, particularly credit type strategies such as multi-asset credit, will have struggled due to the widening of credit spreads, not just in terms of investment grade, but also all parts of the credit spectrum in terms of high yield. I think the real message to give here.
Sorry, Daniel, if I can interrupt quickly, just in terms of, can you explain what you mean by the credit spreads? I think that'd be useful.
Sure, no problem. So within the bond spectrum, we invest in corporate bonds. And corporate bonds are issuances of companies where we expect to be rewarded for taking that additional risk in terms of that credit risk around the actual individual organisation, individual institution. And typically what we see is there's two elements of the return. There's the return in terms of the movement around gilt yields, but also there's the element around that credit spread, that reward for taking that credit risk. And in that environment that we saw around that sort of turmoil, we saw a sort of quite sharp increase in terms of credit spreads. So over that period, corporate bonds suffered quite significantly, although as we've highlighted before, post-quarter end, we've had some better returns from corporate bonds over that period. So if we again turn to sort of the performance and kind of look at the impact in terms of our bond portfolio, we have three separate mandates or three separate funds within our bond portfolio, which are managed by two separate managers. So again, we have a mandate with Janus Henderson, which is a corporate bond, all stocks credit mandate. And again, while that produced a negative return over the quarter, actually the manager there outperformed over that period due to the individual selection of the individual corporate bonds as part of that fund. The second mandate that Janus Henderson has is a total return bond mandate. So looking to add different elements of bonds and looking to kind of be slightly dynamic around those holdings over time. And again, we had a sort of modest negative return given what happened to bonds over that quarter. The one that really stood out is the multi-asset credit mandate with CQS. So this is a mandate that we access through the London CIV, and this is investing in a range of different holdings within the credit spectrum. So not only corporate bonds, but also high yield and bank loans and a range of different credit investments. And given that environment that we saw where all of the sort of sub-asset classes that form part of that strategy fell quite significantly in value as a result of the market shock, we saw a sort of very big, significant negative return from that strategy over the quarter. Now, it's one to be mindful of because actually that is a mandate that the London CIV have had on watch in the past. We recently took that off watch, but they're keeping a close look on performance. And yeah, during an environment where we've just seen where credit spreads and all areas of the credit spectrum suffered, we've seen a very big negative return from that mandate. Just turning to the other parts of our strategy in terms of asset classes, and this is more in terms of the alternative areas. So touching on property, first of all, as many of you may be quite familiar with, there's a lot of uncertainty in the property market at the current time. And to a certain extent, the property market, has frozen to a certain extent. A lot of uncertainty around sort of valuations. Valuers are finding it difficult to put any specific valuations on property funds and on assets. And therefore, we've seen actions taken by a lot of the sort of commercial property funds really to either temporarily suspend those funds or defer any sort of redemptions. And really, those are sort of sensible measures to take in this type of environment, really to kind of protect existing investors and to ensure that there's not any sort of fire selling or sort of short-term trading on those funds. So currently, we're seeing that across the market, not just in terms of the existing fund that we have access to and investments with. We're seeing that right across the board. And again, typically these types of managers will continue to look at that and review that decision on a quarterly basis. So in terms of performance around our property holdings, actually UBS Triton property fund that we have investments with actually outperformed over the quarter, but I would be very mindful of the fact that there's probably a lag around the sort of true performance that we're going to see around any sort of illiquid investments in the current time. So just, be mindful of that. So even though we've seen some strong performance on a relative basis from that holding, mindful of the fact that the true impact in terms of illiquid holdings will only sort of come over time. We have access in terms of property investments, both in terms of commercial property, which is the UBS Triton fund, but we also have a commitment to a residential property fund with M&G. And again, an update there is that we're expecting to sort of fully draw down our commitment of 25 million by the end of this third quarter, so by the end of September this year. And actually, the assets that form part of that fund have generally fared very well, despite the sort of challenging environment we've been in. But I'm conscious that the timing of that drawdown, has continued to be put back. But the latest update from M&G is the end of September for that. Last area I just wanted to touch on is diversified growth funds. Again, the panel may be familiar with this.
Excuse me, Chair.
Councillor Aurora?
Excuse me, Chair. Is it possible to ask a question now, or should I ask at the end?
Sorry, if it's okay, if it's pertinent to what Daniel's saying at the moment, if you go ahead, if that's okay, Daniel.
Thank you, Chair. Thank you, Daniel. Daniel, you mentioned that the property market essentially is frozen and valuations are very, very difficult to achieve. My question was quite simple, actually. Is it, were you referring to the residential market or commercial, or indeed both?
Primarily the commercial market here. So what we've seen, Councillor Aurora, is a lot of commercial property funds, in terms of the valuers, sort of saying, we can't put a true valuation on these assets at the current time. There's too much uncertainty out there. So typically, what they've done is put these sort of uncertainty clauses on the value of the assets. So in reality, while you're not seeing a big movement in terms of the performance or the valuation from the 31st of December to the 31st of March, we do anticipate that there will be a lag and you will see a true impact in terms of that valuation at a later point. There's clearly just a bit of uncertainty around when they'll actually be able to do that, given the uncertainty in the market at the current time. But I guess the key message to give here is to take comfort that the actions that your property manager has taken here in terms of deferring any sort of redemptions is a very sensible measure to take in the current environment. And we've seen that across the board in terms of other commercial property managers take similar action.
Thank you, Chair.
Okay. Turning to the last area, diversified growth funds. So these are the types of strategies that have access to a range of different asset classes from a diversification perspective, but also look to be relatively dynamic in terms of varying the asset allocation between those different asset classes over time, depending on when they see opportunities. And I think it's fair to say that we saw quite a significant divergence of performance from these types of strategies over the first quarter, really as a reflection, depending on kind of how much exposure they had to equity markets, given that it was equity markets that saw the biggest falls in terms of at an asset class level, but also kind of thinking about to what extent how exposed they were to risky assets in that environment. And again, it's a reflection of the different sub-styles that you get within diversified growth funds, which really kind of led to the contrasting performance from different diversified growth fund managers. So if we actually look at your specific managers, so on slide B25 here, you've got 3 different diversified growth fund managers that form part of this portfolio, all of which you access through the London CIV. 2 of those managers, both Hereford and Ruffer, are typically what we see as managers that are more focused around sort of capital preservation, so not looking to sort of shoot the lights out with the higher levels of expected return and a risk profile, but are more focused, yes, around that sort of capital preservation theme. And actually, we saw some strong relative numbers in terms of those performance. So I think over the quarter, we saw a return of about sort of -5% from Hereford, a return of about -1% from Ruffer, which is a very good return in that type of environment, and a return of about -14% from Baillie Gifford. And that's really a reflection of the fact that the Baillie Gifford mandate is more a sort of growth-focused mandate within that diversified growth fund peer group, whereas those managers in terms of Hereford and Ruffer are more focused on preservation. So again, while we saw negative returns, it's important to be mindful of it in an environment where we saw all risky assets fall, and in reality, equity markets fall in excess of 20% over the quarter. Those types of returns really gave you, a good level of protection to the falling equity markets that we saw. So kind of doing what we expect them to do in that type of environment. That's a kind of an overview at an asset class level. What I'd like to do now is kind of just bring it back to kind of what we're seeing in terms of the outlook now, but then actually bring it back to the fund in terms of the specific considerations that you need to be thinking about and kind of how the fund fared in that environment. So if I turn to the outlook first on slide B27 there, I think the key messages there: continued uncertainty, a high degree of uncertainty ahead. We saw, we still think the full impact of the virus outbreak is still to be seen on economies and markets. What we've seen is actually the actions taken by governments and central banks, to a certain extent, has put that sort of downside safety net on markets. But we still think, there's a lot to be priced in. There's still further to be priced in terms of both, valuations of particularly equity markets going forward. We don't think it's fully priced in terms of this uncertainty at the current time. Really what we're seeing is that we've seen an environment where gilt yields have gone to record lows, driven by the moves taken by central banks around interest rates. And we think that the gilt yields and interest rates are going to remain very low for the medium term, i.e. well beyond the sort of period of market downturn that we're in at the current time. And that's a kind of a really, important aspect, because in reality, we've seen a period of very low interest rates and low gilt yields, and an expectation that rates were going to rise over the medium term. But in reality, kind of given what's been happening, the view very much is now that rates are going to stay low for longer and really stay at record low levels, for the medium term. In terms of what's priced in markets, we're seeing, interest rates or gilt yields priced in at sort of almost 0% over the next 2 to 3 years. So quite abnormal and extreme levels to be in. If we now sort of reflect on that sort of challenging outlook and think about the existing investment strategy, but also kind of reflect on potential aspects around the upcoming strategy review, I think it's kind of quite important to reflect on actions taken by this panel and in terms of the existing investment strategy, but also to reflect on kind of the improved position that we now stand in as at the end of May. And kind of touching on each of those in turn, very mindful of the fact we have a diverse investment strategy. We are not solely exposed to equity markets. And as a consequence, those asset classes such as diversified growth funds and also aspects like the property will have given us some level of protection to the large drawdown that we saw in equity markets over the latter half of February and March. We've always had a good level of liquidity within the investment strategy, which is particularly important in that stressed environment. So we haven't had to sell down any assets and incur quite significant transaction costs in that challenging market environment. Now, I highlighted the fact that the end of March represented a very low point. We saw quite a big fallback in the value of the assets over the quarter, standing just in excess of 800 million. As I mentioned, given what's happened to markets post-quarter end, and that quite significant rebound, in particular, an 18% return in equity market post the quarter end, we would expect, our total assets to have increased quite significantly over the periods of April and May. But what it does emphasize is some of the important themes that we should be looking at as part of the upcoming strategy review, both in terms of thinking about that allocation that we have to areas such as fixed income, the areas of sort of typically deemed lower risk areas as part of our strategy, but also thinking about those aspects around some of the alternative asset classes that form part of our strategy. And we've been on that journey of gradually reducing the exposure to risky assets in terms of equity markets. And I think I just really emphasize that that's the sort of continued journey that we'll be on in terms of the areas of consideration for the upcoming strategy review. And in terms of the next piece that I'll be coming on to shortly, we'll be emphasizing that in a bit more detail. But yeah, just really want to highlight that while we've seen that big fall in terms of our value of our assets over the quarter, mindful of the fact that A, we did have some good levels of protection from our alternative assets, and B, our assets have rebounded quite significantly post the quarter end as well. So I'll just pause there because appreciate I've gone through quite a lot of detail, but thought it was helpful to kind of give you that context and that detail around not only markets, but also the impact on asset classes and our specific investments over the quarter.
Thank you very much, Daniel. And that was very well, and thanks Tamara too. Of course, that's very interesting. And well, apart from the kind of is a bit scary and a terrible time, but it's interesting to see how the markets are responding and what what the future might hold. I guess it's still very uncertain, but that was very useful. I've got anyone who has any questions or comments, please type your name into the chat box. Alison, your name's there already. Do you want to? Yeah, over to you for a question.
Okay, so I'd probably a couple of questions. I don't know whether you want me to take them one by one, Chair, or.
However, if you just, go first question, then Daniel can answer, and then you can ask the next question if that's okay. Well, I'll leave it to you. Really, what do you think's best?
Okay, so the first one was, well, Tamara mentioned that the regulator was giving guidance on a sort of daily basis and was focusing on cash flow. I just wondered if liabilities we're looking at, so we're focusing on assets here, but I'm just wondering about the liabilities within the pension scheme. So that was just something I just wanted to check, because it's something that's sort of highlighted throughout the actuarial valuation as well, and some of the other issues that are coming through on the pension schemes, McLeod, etc. So I just wanted to know if the regulator was focusing on that, because that's obviously the other side of the other side of this. And then it was looking at I was going to look at the investment report. Is it B6? It's got, I think we've still got that the number, certainly Fidelity, Columbia and Schroders are all active, and they've all at different times not really been meeting the target. At the moment it's slightly changed, but previously haven't got my previous reports to hand, but I think Fidelity was probably in. So this is only showing a snapshot of a year rather than sort of a period of time. So that's probably my first thing, is that we're only seeing a particular from 19 to 20. And I'm not quite sure what these figures reflect, and whether it is the cumulative one or it's just the years. That's probably my question about the figures, because and I do understand that it is a difficult market. We look at it every day, and it is interesting what's going on in the market. And I know that we are looking at it for the long term as well. But it is also a time when we're starting to look at how we invest and what we invest. So it's just probably, if I do stick at those two things, so the benchmarking, and what I think probably what I'm thinking about is, if we are going to review it, is like, what teeth do we have with regard to them not achieving the benchmark that we've set. And I understand it's difficult times, but it's not always been necessarily a difficult time with some of the performances and underperformance of these active managers. And the second thing is about liabilities. So.
Okay, thank you, Councillor Holt. Yeah, let me pick up both those aspects, and I think Councillor tomorrow may jump in on some of the aspects as well. But if I start off with on the liability side, so you are quite right, very important to look at that. And in terms of the next item, we will be reflecting on the sort of improved funding position at the time of the last valuation last year. Now, conscious, yeah, we would have expected to have seen a fallback in that funding level going through this period of turmoil. I know the funds actuary historically has produced funding updates every sort of 6 months. I may turn to tomorrow to see if there's been any recent funding updates that the funds actuary has provided or is expected to provide in the coming months.
So I haven't received the Kingston one yet. I actually received the Sutton one a couple of days ago. So I'm pretty sure the Kingston one is in the pipeline, and I will update the chair when I receive that.
But as part of the upcoming strategy review, we very much look at that look at the fund's investment strategy in the context of both the asset position and the liabilities. It's a really important piece. And without trying to sort of steal some of the thunder that I'm going to highlight when we talk about the strategy review, yes, it's a really important exercise to not only reflect on the improved funding position that the fund now stands at the time of the valuation, but obviously the more recent period as well. So we actually then project forward that funding level over different time periods based on a range of different investment strategies to consider. So the focus, yes, we look at it at a panel level, at an asset level, but when we look at the investment strategy, we also look at that from a funding perspective as well, i.e. looking at both aspects of the equation, both the assets and the liabilities. In terms of the second area, Councillor Holt, around the performance, you're quite right. I think in the officer's report, they've shown performance over the last 12 months and also I think the last 3 years for each of the fund's investment managers. But actually, I think even if you look over longer time periods, it's a similar trend and a similar picture. In reality, in terms of our 3 equity managers that we have investments with, we've had a very strong experience with our manager in terms of Columbia Threadneedle over almost all time periods. They've significantly outperformed benchmark, met targets over all time periods, which has been very positive. And you're quite right, in terms of the other mandate with Fidelity, which is the sort of core mandate that we have, while we've had better performance over the last quarter and 12 months, conscious that over the sort of longer term, it's probably been more in line with the benchmark. And I think that's the case in terms of the three-year numbers that you can see. And then on the other side of the spectrum, we've had Schroders, where we've seen significant underperformance versus the benchmark they're given, because of the fact that their style has been very much out of favour. Now, that's why I think this upcoming strategy review is quite an important aspect, because we're not only looking at kind of what is our overall allocation to equities, but also what is our combination of different investment styles that form part of our equity portfolio. And you asked us sort of how much teeth have we got? Well, in reality, all these 3 managers, we should hold account in terms of the targets that they've been set and the benchmarks that they're measured against, but also be mindful of what other managers we have access to through any pooling initiatives through the London CIB as well. So that's why I think at a high level, when we do the strategy review, it's not only looking at our equity allocation, but also our subcomponent managers and different styles that form part of that equity portfolio. And one element of that can also be kind of our allocation between active and passive management within our equity portfolio. Currently, we have 3 active managers, but as I'm coming on to in the next paper, when we talk about some of the beliefs, there's very much the opportunity to have an element of passive management within our equity portfolio as well, which would very much be consistent with the beliefs the panel talked about at the last meeting in February. Tamara, is there anything else you wanted to add to that?
So just on the liability side, the pensions regulator has indeed been releasing guidance on the liabilities side too, and in particular asking pension funds to look at the pattern of bereavements in the short term and any changes in longevity as a result of the pandemic and the economic consequences of the pandemic as well. I mean, clearly that's a longer term piece of work. It's not something that anyone is going to be able to do in a week or 2, but it's very much on the agenda of the actuaries.
Thank you very much. Does that answer your questions, Alison?
Yes, it was just certainly things that were concerned to me, and if we're looking at it as we go forward, then that's good. And if we are going to get an update from the actuaries on the liabilities position, then that is comforting.
Thank you very much. Does anyone else have any questions or comments for Tamara or Daniel? Roy, please.
Thank you, Chair. It's a question for Daniel, if I may. On slide B29 of your pack, where you give us a summary, you talk about the panel should consider, and there's 3 bullet points there. The third one, you mentioned the source of equity disinvestments to meet future liquidity drawdown requests for the MNG Residential Property Fund. Could you possibly clarify? I think I know what you're trying to say there. Could you possibly clarify and just expand on what you're trying to say there, please?
Sure. Thank you, Councillor Aurora. So yes, in simple terms, we some time ago made a commitment to invest in the M&G Residential Property Fund, and we made a commitment of 25 million, which was at the time broadly 3% of our total fund assets. What was exactly unknown was the timing of when they'll actually require that commitment to be made. There was a sort of a pipeline, a waiting list at the time, and they were going through that waiting list as and when they sourced opportunities for investments in the fund. So we are, based on M&G's latest estimate, they're expecting that they're going to draw down that full 25 million by the end of September. That is an estimate. Again, it may vary, and we will need to make that commitment to them and provide that value of those assets, when they make that drawdown requirement. Now, in reality, the expectation was that by investing in residential property, we were sourcing that from a reduction in our equity allocation. But obviously, at the same time, we should always look at any sort of cash position we stand as well. So we look not only will we look at sourcing that from equity disinvestments, but we can also look at our cash flow position as well at the time to fund that. But again, it's a bit unknown exactly when that will be coming from, but we need to be mindful of that is on the horizon.
Thank you, Chair.
Thank you. Thanks very much for that. I know this kind of feeds into the next item, so I think we'll pick up a few. We'll develop some of these themes a bit more shortly. Just a quick question in terms of the bond market, fixed interest. And so you mentioned that it's changed. I mean, the yields come down further, and now the expectation has changed, and the impact that has on the bond market. Am I right in thinking it makes it less attractive in terms of investment, or potentially, the kind of returns might be lower than they were just a little while ago? Daniel, if you can.
Yes, thank you, Chair. Yeah, no, you're quite right. We're in a sort of lower return environment now. I think what we're seeing, and again, I'm going to come on to this when we talk about some of the themes as part of the strategy review, but I think what we're seeing is within bonds as a sort of asset class, we're seeing investors look at a wider range of areas within the fixed income opportunity set. And this is, again, consistent with what you'll see around the London Civ and their offering, that there are different types of strategies within fixed income, some of which are more return focused, that are sort of coming to the fore in terms of the environment that we're in, which is very much an expectation for lower returns from more traditional bond asset classes such as government bonds. So we'll touch on that in a few moments, but you're quite right. I think the environment going forward for bonds is much more a lower return environment, but at the same time, an important part of our strategy, given it's that part of the strategy that's looking to provide us the sort of stable returns going forward.
Okay, thank you very much. And I guess from what you're saying, it seems that we might struggle. It's going to be harder potentially to get strong returns from the kind of traditional equities and bond markets, and it seems like potentially that's been exacerbated what's going on. And I know you've mentioned it already, looking at other alternative assets. That's probably a driver behind that, but I think we'll be touching upon that shortly. So has anyone else got any questions or comments that you'd like to make now? Okay, I'll take that as a no. I'd like to, so can we before progressing, if we can just, I'll be happy to note the information is really at the beginning of the presentation in this section about the report on the pension fund valuation performance over the last quarter. Everyone happy to note that, I presume? Yeah, I'll take it as you are. And if I can ask people, so there's a bit, I can hear a bit of background noise. I don't know if anyone else can. Just remind people to kind of keep their microphones on mute if you're not talking. Thank you very much. And I'd like, the next item is the investment strategy update. So very following neatly on. I think it's just going over to Mara to introduce, I think, and be mindful we will be kind of likely to be suspending the live session shortly. But yeah, if tomorrow you want to make if you'd like to introduce this item first, please. Thank you.
Thank you, Chair. So you discussed at your previous meeting the process by which you would be reviewing your investment strategy, and you agreed a set of investment beliefs, including that you are open to both active and passive management, that you did feel that active management could add value net of fees over the long term, that you want to retain a level of diversification of both assets and managers within asset classes, that you want to keep the focus on return rather than explicitly matching assets to liabilities, so not an LDI approach. Given your time horizon, you have scope to invest in illiquid assets, as we've just discussed. Obviously, need to maintain liquidity, and it's worth highlighting that liquidity will become an increasingly important consideration if you move into more illiquid asset classes. As we've just discussed, fund managers in property and infrastructure will have irregular drawdown schedules and will be asking for cash calls periodically and not always very predictably. So we need to have a strategy in place to ensure that we've always got the cash available when we need it, but at the same time are not maintaining an excessively high cash balance that is then a drag on performance. And last but not least, that responsible investment policy should be an important consideration in the investment strategy. And obviously we're going to be discussing that later on in the meeting. So specifically on the issues that I believe the panel needs to consider as part of the investment strategy is around the scope or the desire to de-risk the portfolio further, and whether that's possible and sustainable given the assumptions used in the actuarial valuation. So whether the asset strategy is in line with the funding strategy. And then the other sort of overarching consideration is this requirement to, where possible, increase the level of pooling with the London Civ. And I do understand that it's not possible in many cases to find the required fund management strategy within the London Civ currently. But we could consider increasing the amount of work we do and the amount of contribution we make to the London Civ's work behind the scenes to try and steer some of those funds towards what's appropriate for us. And I do think that as part of the investment strategy review, we should be considering whether we could map existing portfolios to strategies within the London Civ that would meet the same investment objectives. And then specifically, I've listed some considerations for each asset class, particularly, as we've discussed, for equities, whether passive equity manager could be more appropriate rather than a sort of core equity manager that aims to stay fairly close to the benchmark. A cheaper option would be to choose a manager which explicitly sticks to the benchmark. And there are also options within passive strategies to tilt towards specific objectives such as climate change and responsible investing. So that's something that's worth considering, I think. On the bond side, I think it's worth considering whether we still think it's appropriate for all of our bonds to be sort of UK focused. So while we've gone global on the equity side, we're still very much UK focused on the bond side. And does that make sense? Is that appropriate? And could we diversify further on the bond side? I think we need to consider the role of DGFs. Have they performed their diversifying role during a crisis? And do they have a sort of net of fees? Do they provide what they promise? And then looking at some of the more illiquid asset classes, I think we need to think quite carefully about things like infrastructure and property, particularly around where we want to be invested, what we're hoping to achieve through those investments. So often people talk about infrastructure and say infrastructure is a great asset class because it has a degree of inflation protection. But that's not necessarily true, depending on where you invest and whether you're protecting against the right inflation, because obviously it's sterling liabilities that you're trying to manage against. So I think any consideration of infrastructure needs to be fairly detailed and fairly precise, rather than just a sort of generic desire to move into infrastructure. I think it would be helpful to consider our overall approach to geographic diversification across all of our different portfolios, and how we think about currency exposure as well, whether that's something we manage sort of explicitly, or whether it's sort of an accidental outcome of our investment strategy. So whether we've ended up with exposure to currency movements that we intended or didn't intend, whether we want to invest in sterling hedged asset classes or not. And then finally, as I've already mentioned, I do think we need to pay more attention to liquidity and cash flow, particularly as we move out of liquid asset classes into more illiquid asset classes, because it's going to become a much bigger focus of what we need to do. And it's something where we could destroy some of the benefits of investing in illiquid asset classes if we don't have a suitable cash management policy alongside that. Daniel, perhaps over to you to talk through some of those issues in a bit more detail.
Chair, I wonder whether at this point it's appropriate to move into private session if Daniel feels he would like to discuss it more fully.
Yes, absolutely. So yeah, that's what we're looking to do now. So if we so we need to go, well, we'd like to go into private let's get the right section of paper. So yeah, according to the according to the legislation, the Local Government Act, as per that legislation, we'd like to go into private session to exclude press and public for the following item. We need everyone to agree on that, and given this is a videoed session, we need to go around and have a vote on it to do things properly. So I will hand over to Kevin now to go through the vote, and we're voting, just to be clear, on going into a private session. So yes, if you are happy for us to go to private, say yes. Kevin.
Thank you, Councillor. Councillors, I'll ask you in alphabetical order whether you agree to the going into closed session. Councillor Aurora?
Yes, I agree.
Councillor Bainham?
Yes, I agree.
Councillor Goodchip?
Yes, I agree.
Councillor Ha?
Yes, I agree.
And Councillor Holt?
Yes, I agree.
Thank you, Councillor. That's unanimous.
Thank you, Chair.
Thank you.
I will just let IT know, and then I will confirm when we are offline.
Okay.
Critically, because it's a virtual meeting, we have to go through the name vote.
Okay, well that's fine. We'll do that. So if we can, before we do that, can we Fiona, if you want to get us back online, please. Yeah, are we comfortable now to go to a vote? Well, yeah, any other questions? Okay, Addison, yeah, everyone else. Okay, so yeah, Fiona, now if you can let your IT know and get us back broadcasting live, please, and then we'll go to a vote.
Yes, Chair. I'll confirm when you can go live.
Thank you very much. And we will have a comfort break very soon.
We are back online.
Sorry, issues with the mute button. Thank you very much. So yeah, we are broadcasting back live. So welcome again to those watching on YouTube. I'd just like to, well, if we, as discussed, can say if we are happy with the recommendations on the front of page C1. If we are happy to vote in favour of those, please vote yes. Kevin, can you do the honours, please?
Councillors, I'll call upon you in alphabetical order. Will you vote for, against, or abstain? Councillor Aurora.
For.
Councillor Boehner.
For.
Councillor Goodship.
For.
Councillor Hart.
For.
And Councillor Holt.
For.
Thank you, Chair. That's unanimous.
Okay, thank you, everyone. I now propose we take a 5-minute comfort break. There'll then be me. I mean, we are through most of the meeting. I think we've got one substantial item next, which is about the responsible investment. I know a couple of people might be leaving fairly early, but we'll pick that up next. So we'll see everyone back here 11:55. Is that okay, everyone? Okay, thank you very much. See you shortly. Okay,
Chair.
so I think once that's been moved, I think it'd be good to start. Sorry, was that Daniel?
Yeah, Chair, just to say, I'm just about to be joined by a colleague, Jennifer O'Neill, from our Responsible Investment team. I think she's just hopefully going to get access from Kevin to join us just now. Okay,
so we'll wait for Jennifer to join, and once she's joined, we've got confirmation. Thanks, Alex, that you're here, and Paul's back. So we're almost good to go.
We are live, Chair. You can go.
Okay, so the next, no, we won't start until your colleagues joined, Daniel. But the next section is on the responsible investment strategy. Hopefully, you had a look at the draft statement with the options that was laid out in the agenda pack. And who is it to? Sorry, is it over to you, Daniel? So just going. Oh no, Tamara. Sorry, I think you're kicking off. Is that right, Tamara?
Well, I don't have anything very much to say on this.
Okay, well, I don't mind if you want to start, or if Daniel and Jennifer want to start. I don't mind, whatever you think's best way of going forward.
It might be easier actually if Daniel and Jennifer to start the process, and then maybe I can come in at the end around how we actually take this forward in practice and the next practical steps.
Okay, thank you. So Daniel and Jennifer, over to you, and welcome, Jennifer. Thanks for joining us.
Hi, good afternoon. Sorry, it took me a couple of minutes to join there. Hello to you all.
Thank you, Chair. So I'll actually probably just pass across to Jennifer, but just as a bit of background, hopefully most of you will be familiar. Jennifer joined us at the Responsible Investment Workshop that we had recently. She's a member of our Responsible Investment team, so she's actually been involved in terms of helping support discussions around responsible investment beliefs, designing responsible investment policies across a number of schemes, and in particular a number of LGPS schemes. So hopefully should provide some valuable support today, and has been a key component in terms of the production of this policy that we're going to be discussing today. So let me pass straight across to Jennifer.
Thanks, Daniel. Good afternoon, all of you. I suppose just before we go into discussing the document itself, I thought that it might be helpful just to have a little bit of context as to where we are today and how that looks relative to where certain other LGPS schemes are either in the process of getting to or are finalising. It's fair to say that a number of schemes are at the same stage as we are, in that they are looking to refine and to document what they do and their forward-looking aspirations for how they integrate responsible investment considerations around sustainability, long-termism, asset selection, decision-making into their processes. So what we've done, and Daniel and I have had a number of separate conversations with Tamara as well, following the workshop that we had, and collating the summary of beliefs that we discussed and agreed at that workshop with regards to the priority sustainable development goals, which are set out in this document. So using that, as we talked about, as the direction of the priorities of the panel and how they can apply to the funds is really the starting point for this document. What we've then done is made some suggestions that we can discuss and agree today in terms of things that the panel may wish to consider augmenting this document with. The reason that we've done that is to provide you with some guidance and indication of things that you may consider doing. What I didn't want to do was be too prescriptive at this stage about introducing those without today's discussion. So hence why there are a number of items marked in red in the pack. So just for example, looking on page D5 of the pack, you'll see that there are a number of potential items for inclusion. These are not necessarily mutually exclusive, so we can choose to adopt a number of these and multiple in the same section if we wish to do so. They are food for thought and are designed to help you think about the way that you might put this into practice. But of course, this is also looking at the previous paper as well, which Tamara's prepared, it's indicated that, of course, the panel can raise ideas and put forward suggestions in addition to what's contained in this document. That's just a little bit of background. I'll pause there to see if there's any questions or comments at this stage, or any perspectives on this that you'd like to share at this point.
Any comments, anyone? If you raise your hand, I can see the screen if anyone has any comments. I don't think so at the moment. No, thank you, Jennifer. If you want to carry on for now.
Thank you, Chair. So in that respect, then, if we start by looking at the priority sustainable development goals, you'll see that we've articulated those goals that were discussed, and you'll recall that we went through the polling procedure at the workshop itself and aggregated those. I think it's important to recognise that, as we've indicated here, these goals are interconnected. They are not necessarily exclusive of one another, and therefore there is a lot of crossover with and between each of these. So thinking about, for example, the discussion that we had, whereby climate change, Sustainable Development Goal 13, action on climate, is reflected as an overarching theme, there is clearly an interlinkage there between the others which are identified here, for example, energy, equality, justice, and economic growth. So we've highlighted those, and there are, I suppose, a couple of ways that we might consider taking forward this piece. One of the things that we talked about briefly at the panel session, the panel workshop session, was thinking about undertaking an SDG mapping exercise. So looking across the total portfolio and looking at the alignment of the portfolio as it stands today with the agreed priority SDGs. So we can consider doing that. What I would suggest is that we certainly undertake action 1 to communicate the agreed priority SDGs to the appointed managers of the fund, and request that they provide you with evidence of their consideration of the SDGs in their investment processes, so that it gives the panel an understanding of how this is integrated by your appointed investment managers and monitoring that on an ongoing basis. You may also consider to undertake this SDG mapping exercise as a separate point. We can, of course, come back to that at a later stage. I don't know if any of the panel have any comments on that at the moment.
Yeah, well, so it's just, regarding the mapping, how does it work? I mean, these are quite, as I say, there's quite, well, the interlinked themes, they're quite broad themes. How well can can they be mapped, and how useful and accurate would that information be? I guess it's something that is I guess this is something that's going to be used more and more with funds and larger funds. But where are we at the moment, and how? What are your views on it, and how useful it would be?
I think it's absolutely right to say that this is something that will become more and more common. Where the industry has largely started from is focusing on equity portfolios first and foremost. And for example, there's a number of sort of industry bodies out there that look across equity portfolios in particular to uncover the alignment with.
Oh, sorry, Jennifer. I think we've lost you. Sorry, we lost you for a few seconds. You seem to be back okay. So if you want to rewind slightly, sorry. Thank you.
My apologies. I was just saying that the industry has typically started from the point of view of equity portfolios first and foremost, but that there are certainly growing standardization of methodology to look across other asset classes as well. For example, Karen Shackleton at Pensions for Purpose has recently done a piece on this, looking at ways of undertaking mapping exercises. What I would say is that this is developing, and it's not necessarily something which has been widely adopted as yet. It could be something perhaps that we revisit. and we can share with you examples of how I haven't worked with any other funds which have done this at this point in time. I've worked with many funds that have done, as you have, carbon footprinting exercises, for instance, and looking at your exposure to carbon emissions. But in terms of SDG mapping, I haven't personally worked with any. My colleagues similarly haven't worked with any that have pulled the trigger on undertaking this exercise at this point in time. Does that help give some context, Chair?
Yeah, no, thank you very much. I guess, yeah, we could, well, from what you're saying, I guess it's something that, yeah, you said we can revisit it. So I might be minded to say that's something that we don't initially implement. It'll be good to get some feedback from someone, yeah, who's a bit, who's, well, funds that have done this exercise, to see what their thoughts are and how useful it is first, rather than going into it without necessarily knowing how useful the results will be. I don't know, has anyone else got any comments to make on that specific issue? Alison, yeah, thank you.
I was at the LGPS conference, and Karen Shackleton did talk at that on pensions for purpose. So it is, was quite sort of timely that she was talking there, and I'd sort of speak to her afterwards about it. I think it's probably, for me, if it's I think it's I had my concerns about how we would go about it, and whether they were, because when I first read it, I wasn't sure whether it was either or, and you've said it's now mutually they weren't mutually exclusive. So I suppose it's just the ease at which we can do it, because we're sort of dipping our toe into this and we're sort of going along cautiously, and so I think I probably would like to hear that it's not been done, or it's still only certain areas that they're looking at it. Then I probably would like some assurance that that it's something that is going to be has been done and can be easily done, and will give us good outcomes as to help with this process. So that's my comments.
Yeah, thank you, Alison. Anyone else have any comments on that particular issue in the first section? No. Okay. I mean, I don't know how you want us to do this, Jennifer. I mean, were we going to make a decision on as we go through it on the options? Maybe that'd be the easiest way of doing it.
Yes, I think that's yeah, I think that would work.
Okay. So I mean, I think from that, it seems clear we will adopt number one, and number two, something we can revisit again in future. Any objections, or anyone has anything else to say? Well, yeah, differing opinions, then let me know now. Otherwise, we can move on. Yeah, okay. I think so. Yeah, I think I'll take that's agreed. Yeah, Jennifer, thank you.
Okay, great. So we're now moving on to the second section around your broader views on responsible investment. Clearly, we've agreed that sustainability is a priority for the fund, and sustainable investing is, in terms of that spectrum of capital that we discussed, the approach that the panel wishes to enshrine in the fund's strategy. So we have agreement, therefore, that we are long-term investors thinking about long-term sustainable returns, and that we can focus, therefore, on long-term decision making. So in terms of the two options here, I would suggest that it would be appropriate to consider both of these, and potentially to adopt, therefore, both of these. So communicating your beliefs to appointed managers, and sharing your expectation with them that they will have primary regard for that long-term decision-making process, alongside making tactical decisions where that is value additive. Are there any comments on looking to adopt both of those potential actions?
Any comments? Anyone want to? I don't think so. I'm just thinking myself. Yeah, and I'm okay with that. I think no more comments. No comments from anyone else at the moment. So yeah, if you carry on, thanks, Jennifer.
Okay, super. So similar question then on the second bullet point, identification and management of ESG risks. could be financially material, and therefore consideration of those risks is consistent with your fiduciary duty. So what we're asking here is placing an expectation on your appointed managers to evidence their assessment and integration of ESG risk in their portfolio construction processes, including how they, in practice, deal with those risks. So to what extent, for example, do they consider this when engaging with underlying companies, whether that be from an equity ownership perspective, from a debt perspective, etc., or in wider asset management? Are we happy to adopt that?
Yeah, I think so. I think that seems pretty straightforward and quite a sensible thing to do to me. So unless anyone else has any objections, don't think so. No, thank you.
Okay. Just moving on to the third bullet point then, this is again affirming our belief that integration of ESG issues is important to the investment process. And we've got really two options here, which are, these are not exclusive. And again, I think it could be appropriate to adopt both of these. So you are, first of all, seeking a view, for example, from Aon about the capabilities of your managers. So not only what are they reporting to you in their own right, but what is our view of that? How credible do we believe that process is? And seeking that in respect of your incumbent managers and any prospective future investment managers that you may consider, along with, as part of any changes to your strategy, then taking advice in relation to how your consideration of ESG matters influences the construction and implementation of that strategy.
Yeah, no, I was happy with both of these. Any? I think it seems no more comments. I think so I think that's agreement from the panel that we would. You say we can adopt both of them. I think that's what. I think people agree. Thank you.
Great. Just moving on then to the climate-related beliefs, and just thinking about the declaration from the council itself in relation to a climate emergency. I think that this is, and we touched on this in our workshop, but I think that this is sort of implicitly an important point of messaging as well. So when it comes to publication of these documents and the extent to which this is shared publicly, I think it would be important to have regard for the Council's declaration and therefore demonstrate that the panel's consideration of climate change related factors as they relate to the fund and the exposure that the fund therefore has to those issues. So that's the I guess background to the inclusion of that first bullet point there. We're then saying that we expect that your appointed managers will give you evidence of their consideration of climate change matters. Now, a number of asset managers, as I'm sure you're aware, will independently perform climate change scenario analysis on their portfolios and will, if asked to do so, will be able to comment as to what that looks like for them. So seeking that from your managers on an ongoing basis, as well as potentially the second option here, which is that you are placing an expectation on your managers to actively support the transition to a low carbon economy. And we've just given some examples as to what that could look like.
So Jennifer,
reduction targets across their portfolios.
Sorry, Jennifer, you froze for a few seconds there. You were talking about what a low carbon economy would look like, and then we lost you.
Sorry, Chair. I do apologise.
No, it's not your fault.
Clearly not very good today.
Yeah, no, thank you.
Thanks for bringing that to my attention. I was just explaining some of the component parts of item 2 there, so that this is a further expectation that you would place on your managers to actively support this transition. And for example, something which is on the horizon, which is likely to be passed legislatively quite soon, is a requirement for large asset owners to disclose their assets in line with the Task Force for Climate-Related Financial Disclosures, or TCFD framework. That is a global framework which is endorsed by, well, promulgated in first instance by Mark Carney and Michael Bloomberg back in 2015. So the expectation is, from a legislative perspective, that in the UK, all listed companies and large asset owners would be expected to disclose in line with the TCFD framework by 2022. So that is a component of the second item for consideration and potential adoption here. I'll pause there and just see if there's any comments on that. I think that Councillor Holt may have had a comment.
I think she does, yeah. Alison? Yeah, thank you.
It's kind of related to the one that I've made before. Is it's not in place yet. The ambition is, and I know that Mark Carney has said that, you know, any business that doesn't do this will probably not be in business for very long. But then we have had other things happen in the interim. So I suppose it's just a question of that coming into force and companies adopting it and adopting it in a consistent way that can actually be helpful. Is probably, I don't know whether you've got some comments to make. I mean, I'm just wondering whether, you know, whether this is taking it a bit, you know, too far or not. That's my question, really.
Sure, I can perhaps give some comments just from a pension scheme perspective first of all, and then I'll come back to the wider TCFD disclosure framework. There is, and I'd be very happy to share this with you after today's meeting. There is, and we refer to this just in the next item down, recently some publication of quite detailed but helpful guidance for pension funds in relation to consideration of climate risk, and part of this is alignment with the TCFD disclosure framework. So we contributed to the creation of that guidance, and what that's designed to do is to help pension schemes understand their potential future obligations to report under TCFD. It's expected that pension funds would fall into the large asset owner category, for instance, and how that may look from a total portfolio perspective. So that is something that a number of pension schemes that I'm working with at the moment are looking to preemptively prepare TCFD disclosures in advance of the expected deadline of 2022. So there's quite a number of schemes that are working on doing that at the moment. I think looking more widely across the asset owner community, including asset managers and what they do, a number of them similarly are preparing their disclosures in line with TCFD. I can think of a few that are looking to document that this year. I think just touching on your comments around the consistency of that, I think that's a really important point. What I would say is that the guidance is quite granular on how disclosures ought to be prepared. So what we ought to be able to see is cross consistency across managers that are reporting this in relation to their strategies, which I think is an important point, and hopefully that gives you a little bit of comfort that this is something where there is a quite a rigid framework for preparation of that, and there's fairly limited scope for sort of deviation or approximations within that.
Yeah, thank you. Thanks very much, Jennifer. Do you have any follow-up comments or questions, Alison?
I suppose it's just a process, isn't it? So if we're getting ready for it, do we include it? I think probably the answer to that is we should do it, but I don't know the timing of it really. That's the question: is do we put it in now and prepare for it?
I think in terms of what we have in here at the moment is that the fund would be placing that expectation to evidence this on its managers, rather than placing an obligation on the funds to prepare TCFD disclosures at this point in time. Although I think, looking at that sort of future timeline, that would be something that could well be required of the fund as we move closer to 2022. So I don't know if that sort of helps at all in terms of contextualizing where you'd be seeking that from.
Well, it's just that some of them will be earlier adopters and give more, and other ones will do it when they have to do it. So, but it's not to say that, you know, that they aren't doing it. It's just that they haven't disclosed it in a way that can be useful. So, yeah,
I don't know from what you're saying. I think, yeah, I'm kind of broadly in favour of this. I think it's good. It underlines our kind of commitment to, well, the fact we've declared a climate emergency and our commitment to, you know, kind of the environment. And yeah, I think it's I mean, it's something that's coming into place. So we want to make sure that managers are taking it seriously. And I think that's kind of, it's an important, I think it'd be a useful consideration, I think, when we're looking at investment managers. I imagine most big companies and big investment managers will be, yeah, important legislation, they will be. So I don't think it should be a huge impediment to making investment decisions. And if managers aren't taking it seriously or haven't got anything in place, then that may be something that we should be, you know, well, it should be a cause for concern anyway, I would think. So I think, yeah, I appreciate, you know, we don't want to be tying our hands too much, but I'm broadly in favour of having this in initially. And it's not, as you say, Jennifer, I think you're right in saying that it's not that they've got everything kind of you know, dotted all the I's and crossed all the T's in terms of their commitment. It's just that they've got to demonstrate they've got, you know, they're taking these disclosures seriously, and they're starting the process, I think. Anyone else got any comments or feedback on that particular section? So I don't know. I mean, are we happy to include both those points? I guess in particular point 2 initially. Alison, would you be happy to do that?
Yeah, I'm happy to include it, but for me, it was the analogy of the iPhone versus Samsung. You know, whether they, you know, that one of them produces the item and the other one doesn't, so they actually will give could give very different statements, but it's because one produces something and the other one just takes components that's been produced by someone else. So it's just about the information. But I think it's good to. I think I don't have a problem with it being included. I just don't want it to be. It's good to have that information there, and I think companies should it. But it just feels like sometimes you might be comparing apples and pears, and that's the bit that is slightly concerning for me.
So just because, okay, so it's looking at, from what you're saying, Alison, it's looking at the overall picture and the other factors, and not, it's, you know, kind of footprints. So yeah, kind of carbon footprints have different impacts all the way along the kind of supply chain and the business process. And, you know, you've got to look at the overall picture, I think is what you're saying. But having this, I don't think impedes that. It's just not you relying on any one particular factor or metric when making the decisions. Yeah, okay.
And I think that's really important. I think that's an extremely valid point to communicate. And what I would say perhaps around that is that by also seeking comfort when you are monitoring your managers and when you are potentially looking to appoint or to make changes to the suite of managers that you have in place, the view that you may seek from us on that would consider their capabilities in totality and to question which disclosures they present to us. It would go quite a bit deeper than that, if that just helps to give some comfort.
Yeah, I think so. I think we're happy to incorporate both of them, and yeah, no objection. So thank you, Jennifer. Going to carry on, thanks.
Great. The next bullet point then is I mentioned this this guidance just a few moments ago, which again, delighted to share this with you. It's been published by quite a wide cross industry group, the Pensions Climate Risk Industry Group, which links back to the TCFD framework that I mentioned, and really this is around how pension funds can consider their exposure to climate risk. And one of the tools which is endorsed by the TCFD, as well as others, is the use of scenario analysis. I also mentioned that a number of investment managers will be performing this analysis over their own portfolios, but looking at this at a total pension fund level, thinking about assets as well as liabilities, can be quite informative in giving a picture as to what exposure looks like. So the purpose of this inclusion is to reinforce the belief that climate risk is relevant to the fund, and ought to be considered as a forward-looking risk. So what this is saying is that the panel would consider the use of tools such as climate change scenario analysis to establish the fund's exposure to climate risk. Are there any comments on that?
No, I mean, again, I guess it's how reliable, accurate these kind of tools are. But I mean, I think that makes sense, and yeah, I like the idea of incorporating. Yeah, I mean, underline the fact that this supports our fiduciary duty rather than kind of having to doing this just because it's a good thing to do, if you see what I mean. So I like that. Yeah, I guess the question is about the tools and how modelling tools and how useful they are.
Sure, I'd be pleased to share some thoughts with you on that. Tamara, I don't know if you have any comments. I wondered if you might be unmuted there.
Yes, well, particularly, so my concern would be how effective those tools are on non-listed equity portfolios. So, how would we be able to do this in practice across residential property, across pipeline infrastructure, whatever it was, that wasn't vanilla listed equity portfolios with standardized disclosures?
Yep. I suppose some brief thoughts on that are around the use of long-term forward-looking capital market assumptions and assessment of risks to forward-looking assumptions as being one component of that. But I'd be happy to share some fuller thoughts and details with you on how that can work and what's being used in other cases.
Thank you. Do you have anything? Any comeback or any follow-up question? No.
Well, I suppose my concern would be that we commit to do something and the commitment is taken to apply across the portfolio. We would then look slightly foolish if actually we then have to caveat it with, oh, but we couldn't really do the same thing across all the portfolios, so we had to fudge it a bit on this asset class or this asset class. I think we need, if we're going to commit to something like this, we need to be confident that we can do it for everything that we invest in.
I think the answer to that is that you could do this across certainly across asset classes that are held, but perhaps it would be useful just for you to see some examples of that working in practice and perhaps add some flesh to the bones of that.
Yeah, well, are you suggesting you're suggesting showing us now? Sorry, or is it something to do afterwards?
I think it would probably make sense to do that as a. It's.
Sorry, we lost you again. Sorry, Jennifer, we lost you again briefly. So you think it makes sense to do that, and then we lost you.
Sorry, I think just in view of it's a pretty in-depth subject, yeah. And I think it may make sense to have a separate discussion on it. I guess for the purposes of now, what we're saying in the document here is that the panel will consider. Now, that doesn't necessarily tie you to implementing, but it does indicate an aspiration to consider ways of doing that. And so I wonder if that might, for now, be sufficient for where we are today.
Yeah, that makes sense to me. Yeah, I mean, would that be something we publish, or is that something we kind of keep? I mean, I guess some of this we can make fully public. Some of these things we can just kind of keep.
Indeed.
Add-ons.
Indeed.
So I don't know whether you want to say consider we put that in the kind of published statement or not. I don't know. I know Alison's got a question, but tomorrow, do you want to come back on that very quickly?
Sorry.
Sorry, I couldn't unmute myself. Yes, I think if I believe that the panel's commitment was to transparency on this where possible. And I do think it'd be a nice commitment to be able to make. I just think before we make it, we just need to be confident that we can really implement it. So I personally would feel more comfortable holding back on it for now until we're confident that we can do it.
Yeah. Okay. So not include that in any can publish statement yet, but we will be, as you said, Jennifer. You can show us worked examples. We can have a more in-depth conversation just to make sure that we're all comfortable that this will be workable, and then we can look to add that at a later date. Is that what you're thinking? Yeah. That's what we're hearing. Yeah. Tomorrow, is that what you think?
Mm-hmm. Yeah.
Yeah. Okay. All right. Yeah. So I'm happy to come up with that kind of suggestion. Alison, you had a question that was around this.
Mine was actually surrounding the process, because I'm feeling there's bits of it that I'm not clear on what the outcomes are going to be, and the implementation and the outcomes. So I just wanted to ask about the revisiting this. So if we're going to publish this and we can't implement it, or if there's things that we decide today we don't want to include because we don't have enough information, we can revisit it. Are we planning to revisit our investment strategy on a annual basis, or I don't know. That's my question, is how often are we going to review this, and if we don't put it in today, what would be our next opportunity to do it, because this is an evolving situation and is an evolving strategy.
Well, yeah, I think it's important to underline that this is evolving, and this is not something that's set in stone by any means. I mean, so far I think we've agreed everywhere up down to this point. I think there's one point for now that we will revisit when, I guess. I don't know if we can't put dates in the diaries just yet, especially things as where they are. But I think at some point Jennifer will come back to the group and present specifically for now on this issue around the modelling tools, and then we can look to incorporate that potentially in the statement. But we'll see how we progress. I mean, I think kind of 2/3 of the way through the statement. If there's any, we'll see what else comes up and whether we have any other kind of decisions we will need to defer, and then we can look at timescales. But for now, I think it's just this one item. We can come back at the next meeting or another meeting soon, and we can pick this particular point up, and we'll see how the rest of the kind of conversation goes. I think that's I think we've kind of agreed on that this is something we won't include initially in the statements, but we will. Jennifer, you'll come back at some point when you can, and we'll talk this through the modelling tools in more detail. Then we'll make a decision about incorporating that into the responsible investment strategy or not. So I think we can move on to the next for the next bullet point. Thank you. I think that's okay. Anyone, any questions on that? Were we happy? I think we are. Yes, not unhappy with it. Sorry, tomorrow.
I mean, obviously there's nothing to stop us doing things that aren't in the policy. My concern is just that we shouldn't put things in the policy that we're not 100% sure that we can do. We can always do other things on top anyway, and actually put them in paper at a later stage, at a more formal review of the policy.
That's sort of kind of what I was trying to get to, is that we get, it doesn't stop us doing things and be part of without actually putting it in black and white and publishing it, and especially if it is evolving and something that we can't actually do for all of our investments. So I know we're just fixing on this one, but it's been my concern over a number of them, and I hope tomorrow, if you've got other concerns like that about implementation, that you will bring that to our attention.
And I suppose my other concern is that there is a cost to doing all of these things, either in terms of gathering information, receiving the fund manager's information, the fund managers then charging us to produce the information, the investment advisors charging us for their advice on the information. All of this is going to have a cost of some sort. And I think we need to consider the impact on the business plan for the pension fund more broadly.
I think that's absolutely true. What I would say is that the decisions I think that we've agreed to date, it would be my expectation that your managers would provide this without charging you. I wouldn't expect them to levy a fee for provision of this. I mean, you're of course right to say that there could be costs incurred as a result of our support, but to date, I don't think that there's anything sort of fundamental here that would incur major fees, and certainly not from an investment manager perspective. If that helps at all.
I probably I don't know whether you want me, but I would probably, I think this is where I'm beginning to feel less comfortable with this. If we don't know what the costs potentially attached to this, and we've not looked at it in that way. So implementation and costs and availability of information. So I'll leave that with Tamara and Mark.
Yeah, certainly that there may be information out there. I mean, it's a bit like voting records. All the fund managers produce summaries of their voting records, but they each produce it in a different format. It's then very time consuming to go through that information, synthesize it and summarize it and form an opinion on it. So all of these things have a cost somewhere. And it may be that it may be the right decision that the panel wants to shift some of its emphasis from one set of monitoring to another set of monitoring. But we just need to be clear before we commit to a certain amount of extra work or cost that we know we're going to be incurring that, and that is something we want to do and we believe is important.
Okay, yeah, thank you for that. So I mean, we're not going to have presumably we won't have a clear idea of cost at the end of this meeting. I mean, I understand what you're saying, and hopefully you're right. Yeah, Jennifer, it's not going to be a huge extra cost for what we've agreed thus far. But from what you're saying, Alison, tomorrow we won't have we won't have a clear idea of what extra costs and extra work will be involved. So I don't know. I mean, therefore I see it being difficult to kind of agree on these points and having a statement ready to publish. It's not the end of the world at all. I mean, I guess what we could do is carry on looking at the points we want to include, and maybe not thinking so much about the cost for now, but looking at the points we'd ideally like to have in the strategy, and then we will need to kind of have an exercise where we go away and look at the potential impact on cost and time and other things, decision making, the rest of it, that this will have before we can then kind of decide whether we implement, what to implement, and what not, potentially what to exclude because from a cost perspective. I don't know anyone else got any further thoughts on that, but I think that's I don't see how we can come up with a we can agree now. If we could say about cost, we can't. I don't think we can agree to what we're going to include now without kind of having that information provided. Any comments?
I mean, I think it's about ambitions and outcomes. So I'm not saying just because it's additional work, and I think Tamara wasn't saying just because it's additional work. It's just whether we think the outcome of that additional work is going to be meaningful and then input into our investment strategy, and it's certainly to do with this area. So that's the bit that I think is probably for me is missing. So it's just I don't really. I mean, I've looked down this. I have read it, and I did struggle with them because I did sort of think, well, I don't actually know what some of it. I'm not clear what it means and what you can actually get. And so a lot of them, so apologies if I keep on, speaking on this, but I just don't understand the, what we're actually trying to achieve and what that looks like. And I think that's why Tamara's input and and Jennifer's input is really helpful, because it's just given me a lot more sort of flesh around this as to what we're actually looking at. So I'm going to just confess that this has actually, reading through this beforehand, was difficult for me to know what I should be saying and agreeing to.
That's fine. That's fine.
And I think really that's where.
Go for it.
Yeah, I think that's really where the value of today's discussion comes in, is just opening that up and making sure that sort of across the panel we're comfortable with what we are saying, why we're saying it. So hopefully that this is helpful in terms of providing that context and just opening that up.
Yeah, thank you, Jennifer. Yeah, I think that's right. I mean, that's the reason why we're having this as well, is to give context and more information for us, so that we are able to start making decisions. So I guess it's where so when I was looking at this, I think there's the one issue we just touched upon about the using the modelling tools that we're not sure about the efficacy and the like, so we can come back and revisit that. But from what you've been saying, sorry, Alison, there might be other areas that we've already gone through that you're not sure about yet, and you'd like some more information before we actually kind of say yes, we're going to include this in the strategy. So from what you're saying, I don't think we don't have to. We don't have to come up with a strategy today and have it ready to publish tomorrow. I sort of get to the point where what do we need? I guess I think this is still useful, going through what we like to include, and having an idea of what we'd like to include, and then it's looking at whether costs and benefits is for some, maybe some more than others, whether it's worth it. We get a better feel for what it's going to cost, how much effort, time, everything is involved. I'm not saying that's it's still, but it's just making sure that that's still worth the outcome we're looking for. So I guess that's something we're going to have to go away and work on and come back to then decide finally what we want to include and potentially what we don't. So just working out for a way forward. For now, I guess we can carry on. I think we should carry on going through the points and ask questions, so that we as you said, Alison, some things are less clear, harder to take on board than others, and will require a bit more explanation. So I think we should carry on doing that, and then we need to decide how we go forward in terms of working out the implementation, the costs, and the what's involved in kind of following these guidelines to make sure that we're happy with what we're implementing. So I suggest, I don't know, any comments on that? Are we happy to kind of carry on going through this and getting your thoughts and going through this, so we get the explanation as to what exactly they mean, and getting your thoughts and comments, and then we can decide how we want to proceed after going through this, going through the statement. So I think if you want to carry on for now, and then we can kind of decide at the end how we want to proceed. And we don't, as I say, we don't have to we're not going to publish it straight away, but we need to all be clear exactly how we want to proceed after going through the points. So Jennifer, do you want to carry on? Going through kind of from where we were before. We talked about the modelling tools, and that's something we need to know a bit more about. So that's fine. If you want to go to the next section, please.
Yeah, absolutely. So the next point is really specific to the view on fossil fuel exposure, and considering this as part of your overall exposure to climate change risk potentially. Now, what we touched on as part of the workshop session was that a number of LGPS schemes have really been sort of grappling with the question of fossil fuel divestment in wake of both the declaration of climate emergency, as well as pressure from external sources, for example, through the Unison campaign, through Extinction Rebellion, and so on and so forth. So a number of schemes have developed a policy on their stance on fossil fuels as a component of their wider approach. So that's the purpose of the inclusion of this element, simply to say that the panel believes that it is important to consider climate risk as a whole, rather than looking at fossil fuel exposure as a specific aspect to divest from, and that then sets the tone for the points 1 and 2 under that bullet point, which is first of all thinking about your prior exercise to look at your portfolio's carbon footprint. Now, this is absolutely for discussion. There was some consensus at the workshop session that repeating that exercise periodically would be useful in terms of providing a benchmark and measuring against that benchmark on an ongoing basis. So just in view of some of the considerations around not necessarily specifying formal targets at this point in time on a public basis, what we've said is therefore that the panel will revisit that benchmarking exercise on a regular basis. Now that regular basis is not defined, and that is perhaps a point for discussion and agreement as to what we think is appropriate here. Many schemes do this annually, some do it triannually, some perhaps less frequently than that. So there is a potential range of choices there, and clearly going back to our earlier discussions, that there would be a cost attached to that exercise if you were to go through an external provider, as you did last time. So that will of course be a component of your decision making as well. The second point here for consideration is emphasising support for disclosure under the TCFD framework that we've touched on, and communicating that expectation that your managers will support motions that underlying companies will disclose in line with TCFD. That is therefore going to have really no cost attached to it. That is an expression to the managers and an expectation being placed upon them in their portfolios.
Yeah, thank you very much, Jennifer. Anyone, any comments or questions on those 2 points? Well, on the bullet point and the 2 numbers after. I mean, I think, yeah, I think it's key. I think that's one of the things that we were clear on. We like the carbon footprinting exercise, as you mentioned, Jennifer, looking at the overall impact on the environment from taking carbon footprint rather than just looking at fossil fuels per se. So I think that's important we do that. So there's a cost involved. So I don't know if we need to come up with I guess that's something we can look at. If we're going to look at cost, we can come back to and decide upon how regularly we want to do that, looking at the cost. But I think, yeah, I think, I'm quite clear. I think we need to have a carbon footprint analysis of the benchmark that we can measure progress by. And as you said, the second point doesn't have a cost kind of attached to it, and it seems sensible. So I think those are. I'm happy with those. Any comments on those 2 points? I think. Okay, I'd say there's no. So yeah, thank you. Thank you, Jennifer.
Okay. The next part that we again touched on as part of the workshop session is the fund's membership of the Local Authority Pension Fund Forum, and in particular their stance with regard to engagement with underlying investee companies as opposed to pursuing a divestment first approach. Now again, this links back to some of the prior discussion around fossil fuels specifically, but is wider than that, in that what this is saying is that the panel believe that engagement is a way of improving and being an active participant in the just transition, taking into account some of our considerations around justice and equality alongside climate transition to a low carbon economy. So what we're saying here is effectively supporting via membership of the LAPFF the engagement first stance, and that is your expectation on your managers, that they would prioritise engagement. Where that does not yield positive results, you would support their decision to divest from underlying companies, and that you're expecting them to give you evidence of the way that they are using their weight of institutional capital, the fund's capital, as well as their wider investor pool, to exercise those engagement duties. We're also saying, just in the third sort of sub bullet here, that we don't at this stage support maintaining an exclusion list. So beyond allowing your managers the flexibility to make investment decisions and implicitly excluding by not selecting assets on the basis that they don't believe that those are sustainable or yield a positive forward-looking investment return that is appropriate for their portfolio, we don't support maintaining a separate exclusion list which is based on ethical or moral principles. Are there any comments on these sections?
Anyone? Any comments? I mean, yeah, I think they make sense. Yeah, I don't think we wouldn't be going down the exclusions route yet, but I mean that's something that obviously we can revisit over time. And yeah, I think we did kind of. I think the consensus was for engagement rather than divestment. So I think I think just yeah. I'm kind of. I think those are quite extensible to have. And any other comments? I mean, in terms of cost implications, I don't think there's a huge cost implication with these. It's more of a kind of statement of beliefs.
Yeah, I would agree, Chair. I don't think that there's a particular cost.
Okay. Yeah. All right. I think we seem to be no more questions. I think we seem to be happy with those points. So Jennifer, thank you.
Okay, so that then leads us on to the next section, active ownership. And really what we're focusing on here first and foremost is that, well, we recognise that we have the ability to act as stewards of capital and indeed should discharge that responsibility appropriately. So we have a couple of considerations here, again, around your manager's use of voting rights, for instance, and Tamara made the point very eloquently earlier that managers will provide summaries of their voting records, which are not necessarily always in the most easily digestible format. What I would comment on is that that is a component of the information that Aon gathers on each manager and strategy when reviewing each manager on an ongoing basis. What proportion of voting rights have been used? What proportion have been cast against management? What are the themes emerging from those voting decisions? How does that prioritization exercise work, etc. So that is something that you could get colour on through that or via the managers directly. So we have some statements here around what your expectations are and what you would wish to receive in terms of affirming the discharging of those obligations. So any questions on the three areas for potential adoption here?
Any questions? I'm just going through them again quickly, just see if there's anything that comes to mind. Anyone? Any other comments, questions on those? Yeah, again, so I mean, again, in terms of kind of time and effort, cost implications, not a huge amount there, I would say. Is that right, Jennifer?
I would agree, yeah. I mean, I suppose in terms of time, it would, I think, make sense, given that we're saying that you will seek a number of items from your managers. It would make sense to build in some time at, for example, a meeting to discuss in aggregate the outputs from that, so that it is something that the panel can discuss and note as part of the overall business plan. So that I would suggest it's worthwhile having some time to do that. Would be my sort of real comment there.
Well, it's time to decide exactly what you require from.
No, sorry, Chair. In terms of if we adopt what is laid out in these 3 points here, when you receive that information that we're seeking, so for example, so time to discuss the outputs of that gathering as opposed to deciding what we want. Does that make sense?
Sorry, absolutely, yes, of course, thank you. So it would be even more things to do during the pension meeting. I think it's important we can manage it. We can arrange it sensibly. Okay, I think that's okay. Moving forward. Thank you, Jennifer.
Okay. Just then looking at your membership of the London Civ, and really this is a statement around your belief that collaboration with the London Civ as well as LAPFF is of importance in terms of that gathering of capital. And also note from the preceding paper that the panel would request the London Civ to provide them with inputs in terms of how this is taken forward. So again, this is really how does the London Civ take into account their approach in fund manager selection, monitoring, etc., and using the benefits of participation in the London Civ.
Yeah, I mean that seems, yeah, it's kind of, yes, it's very sensible, self-evident. So I think that's yeah, I think that should be fine, but uncontroversial. Any comments about those 2 points? Engagement with the Civ and LAPFF? No. Okay, thank you. Yeah, thanks, Jennifer.
Okay, so we now move on to the final section of this document, which is around transparency and disclosure, and just appreciating the comments that were shared earlier on, I guess, the aspiration, both from a governance perspective and from a transparency perspective, to make public the fund's commitments. Now, what we talked about in the workshop is that the panel could choose, and I think we've agreed that this would be appropriate, that you can have internal documents for your own reference, as well as public documents which distill and summarize the key points, but don't necessarily need to be as granular as something that you may choose to maintain for internal purposes. So that's really the direction of this section, that you'll publish a summary of beliefs and your ongoing activities as identified here and as we've discussed today. And that periodically you will update and provide disclosure over your monitoring and progress. What that could look like will depend on, I suppose, the approach to maintenance of those internal pieces that I mentioned, and not necessarily, for example, setting formal carbon reduction targets, whilst that may be something that you choose to do internally, and the level of granularity that you disclose publicly there is therefore up to yourselves. So perhaps if I just check if there's any queries, concerns over what's shown here, or any further detail that you want to go into.
Yeah, thank you again, Jennifer. I mean, just on that. So yeah, I agree. I don't know, I mean, from feedback we got in the conversations at the last the first ESG session. Yeah, setting targets may not be, public targets may not be ideal. I guess we can think about having internal ones. I guess the only concern is we don't want to focus on reducing carbon one thing, as opposed to and then we lose track of other factors, impacts that might have if we're just focusing on reducing carbon footprint to reach the target. But I guess if it's an internal ambition rather than a target that we're going to be held to account by the public, then that hopefully shouldn't have too much. We should be good monitoring, but good to set that target, something to aim for, to move in the right direction, but without kind of losing sight of the other factors that are equally as important. So yeah, I agree with that. Sorry. Okay.
Sorry, no, just to sort of add to that, I guess what we're saying, or what we've said here in this document, is that following looking at the portfolio's carbon footprint, you may choose to set carbon reduction targets. And going back to our earlier conversation around having a benchmark and measuring against that periodically and determining the frequency of that monitoring would influence how you approach this aspect of reporting. So I think fleshing out that earlier piece will also influence what is taken forward here.
Okay, thank you. Samara, it looks like you've something to say.
So just the final bullet point under transparency has brought back the SDG mapping sort of via the back door. And if we're not ready to commit to that at this stage, then I don't think we should include that point
Agree.
via either.
Yeah, good point. I think that's, yeah, that makes sense. Thank you, Tamara. Any other kind of comments on that section for now? Or any other broader? Well, so I think we need to kind of be clear exactly what we're going to be kind of agreeing on at this stage and how we're going to progress this. Before I do that, any further kind of comments more generally about this piece from anyone, or anything to add? Any other questions? Tamara, yeah.
Can I just make a couple of points? So obviously we've talked about the cost and time implications of this, and I think, yeah, your time in particular is going to be a key consideration. So how much panel time do we have to devote to these things, as well as obviously officer time? And I think we also need to consider who we would like to, if we agree this policy statement, do we want to consult with any other stakeholders on it? For example, would we want to consult the board? Would we want to consult with employers on this statement? I think it is generally viewed as good practice to consult on these sorts of things where possible. And I think it's something positive to be consulting on. It's not a dry actuarial question. It's genuinely of interest. It could help engage employers and scheme members. And then I think it just, in order to be a standalone document, I just think it needs a kind of introduction. It needs a bit of scene setting. And then obviously we need to just go through and make sure we've taken out the ones we're not publicly wanting to commit to at this stage.
Thank you, Tamara. Yeah, no, you're right. In terms of, yeah, if we are going to be kind of reporting back to committee on these, or the panel on some of the information we've got, that is more time. And I kind of, yeah, and we do have very long meetings already, yeah, as today. And so that is, yeah, that is yeah, something that we do have to consider, as well as, you know, other costs. Thanks, yeah, consulting, I think, yeah, that makes sense. And I think that's, yeah, as you say, good practice to do that. So these are things we have to consider before we, I guess, implement anything, we publish anything concrete. So, Alison, do you have any comments?
Yeah, again, I think I'm just looking at the original paper drafted by Tamara, and it's looking at what the recommendations are and what we're going to do next. So I think I probably would need to know what actions that we've agreed to here, and what the shape of this is coming back, because I'm feeling that I've got a lot of feelings with regard to this this paper, and I'm not sure that it's ready for consultation or public consumption. Quite, you know, that's just I'm just not sure. As like, has it to come back to committee? Are we to work on it the interim and come back to committee? I'm really just asking what, you know, are we agree, you know, with that the recommendation of the report initially? Are we still in that space? And if so, I would need to have specific points from this meeting that need to be followed up on and clarified before it's taken for consultation or disclosure any wider.
Yeah, no, absolutely. That's what we're coming to now. So yeah, a few points raised, as you say. So that's what I propose to be kind of we decide upon now, so we're all clear about, you know, what we've reached, what we have agreed on, and what we need to do now. And and maybe towards the next meeting, before we have a policy we're ready to publish. So I mean, just going through it, I guess there were the points that we went through. We're not ready. I think we agreed we're not ready for the SDG, to publish the SDG mapping yet. That's something that we're going to come back to, and Jennifer's going to explain more about that at some point. And then we can, you know, as that evolves and we become more familiar with that, then we will potentially, you know, incorporate that at a later stage. Similarly, with regards to, I think, the modelling tools, we weren't, we were not kind of ready to include that as yet. As Tamara pointed out, the last bullet point at the end about the SDGs, we can move that in as per the kind of first page. We haven't necessarily agreed to everything else. So those are the things we, I think, agreed that we're not going to include for now. We need to do a bit more work on. I think you've also mentioned kind of concerns about cost and time implications. So I think that kind of looks at what's there as a whole. I think we need to go away and come back to group. We need to do a bit of work in between with maybe tomorrow, Daniel and Jennifer, maybe to look at the extra cost, extra time implications. Then I propose, we have that information, then we can come back to group next time to hopefully agree a strategy, a final draft, I guess. In terms of consultation, I don't know when we would want to start doing this consultation. Do we do that now, or do we wait till we have a kind of agreed draft that we're ready to publish and then do the consultation? So I'm open to feedback on that. And yeah, just any feedback at all about what I've just been saying. So yeah, we're not going to agree anything. Just be clear, so we won't agree categorically what the statement's going to be today. But I think this has given us a good steer and a better understanding of what the options are. I guess we just need to find a bit more information about particularly around cost and time, and then it involves consultation along the way. So any thoughts on that, please?
Councillor Bainan, could I come in? So I think, Rachel Howard, Acting Assistant Director of Finance. I think what might be helpful, just risking, I don't want us to lose pace at the same time as trying to obviously answer all the panel's questions and make sure we fully understood the costs of implementation. So I think you've summed up correctly, Councillor Bainan, what I think the panel have agreed in terms of the points in the pages that we've not agreed to. So there's three points to come out in terms of the draft strategy. I wonder whether it might be helpful if we were asking the panel today to agree the draft in principle with those 3 points taken out, and we then as officers work with Aon colleagues to kind of firm up the costs of implementation of that, look more closely at that, and then also carry out the consultation, and we could come back to another panel meeting with the results of that consultation, information about the costs, and a final draft for formal agreement. Would that work?
Yes, thank you very much for coming to our rescue. That sounds very good. Sensible way forward. I think. Well, I don't know. Anyway, any other? I think that sounds sensible. So we'll be agreeing kind of the draft subject to the cost review and consultation, I think. What you're saying, and then yes, we could bring it back. So yeah, you're right. We don't want to lose momentum, and it'd be good to have this, but we don't want to be implementing something that we're not all happy with or clear about either. So I think that sounds like a good way forward. Any comments from anyone or other officers? I don't know. Presumably we could agree to this. So maybe Kevin or Fiona want to come in. We could agree to this with the 3 points removed, subject to the cost review and consultation. Would that be something we could agree to on this point?
Yes, Chair, we can, if you can confirm what the 3 points are, so we can be absolutely sure what we're going to remove from the resolution.
Okay, thank you. So yeah, I'll read them out and just make if someone can confirm that. Well, confirm that is the case. So going back to the start, so it is removed. So in the first page, so the first page is point 2 about the SDG mapping exercise. That's to be removed. Then on the second page, again, kind of under climate related beliefs, number 2. No, sorry, beg your pardon. Under climate related beliefs, the second from bottom bullet point, number 1, about the modelling tools, taking that out, and then at the end, the very end, the last bullet point, the panel agree that carbon footprinting does not cover all of the SDGs and the SDG mapping section. So those are the 3 points, I think. Anyone else? Yeah, anything else I missed out, or anyone disagree?
And just also to remove that the bullet point in red right at the end, the one that says internally, because that won't be one that goes into the public.
Oh, sorry. Yeah. Okay. Yes. Okay.
So can I
Kevin,
on page D5?
Okay. So, D5. Yeah.
It'll be point number 2 under broader invest. Oh, sorry, I beg your pardon. Under point number.
Oh no, sorry. So no, point 2. It's under agreed priority SDGs. Point 2. The panel will undertake an SDG mapping exercise. That one needs to be removed.
That's number 2, right?
Yeah.
Yeah.
SDGs, and that's on page D5.
Yeah.
Then on page D6 was the point on climate control, and that was point climate-related.
It was the bottom one, the bottom red one on that page.
Yeah.
Point number 1 was the second point, number 1.
Yeah. That's right.
The panel would consider the use of climate change scenario modelling tools.
Okay. Then there was a third point, the very last point.
Yeah, D8, the last bullet. Well, it was the red. So it's the red number 1 internally. That doesn't. Yeah, that's an internal reference that could come out. And then the last bullet point: the panel agree that carbon footprinting does not cover all of the SDGs. That one.
Sorry, I just am trying to make sure I get this all right, so I don't mess it up in a minute.
Yeah. So the D8.
D8. That point under transparency must come out. The red point.
The red point and the one below it.
Yeah.
Okay. Thank you very much.
Yeah. Chair, just to confirm, I also have my colleague Martin Newton in the meeting who's been taking detailed notes, so we will have points covered. Okay,
excellent. Thank you. Thanks, Fiona. Okay. So, any more comments or questions? Are we happy in what we are going to be agreeing to? So, just to reiterate, so with those removals we just discussed, we're going to be agreeing this kind of draft investment policy statement, subject to the officers and Aon going away and reviewing costs in terms of time, money, implications, and consultation with stakeholders, and coming back to present this at the next, hopefully the next panel meeting. Is that? Do we need to do a named vote? Do we, Kevin?
We do, unfortunately.
Okay, so yes, can you? Well, over to you, Kevin. Thank you.
Councillors, if I can call upon you.
I speak. I mean, I don't. For me, I don't know who the stakeholders are, and who we're going to get in contact with. So, I understand we want to go forward with this, but I do. So maybe it's something that I need to follow up with officers offline. But I would quite like to know which stakeholders we're thinking of going to, and whether it's in line with what others do in because I would want to make sure that we do include as many people as possible, the right people, because I think it is a good thing to be doing. And also with this statement, is it in line with what other places are doing as well? I'm hoping, because Aon have brought it forward, that it is a fairly standard document. I'm just concerned that it's a long document with lots of information in it, and I'm not quite sure what it's going to look like, and I probably do need to go away and do some research myself as well as to what other ones look like.
Do you mind if I just make a couple of brief comments on that? Is that okay, Chair? Just in terms of what this looks like relative to others, there is a pretty wide spectrum out there. This is actually towards the shorter end of the spectrum in terms of the summary. So that there's a number, and I'm pleased to share links with you, which I'd be pleased to do after today, to other public documents which are published by other LGPS that you may consider looking at, just to gauge where they are, where they have gotten to. But there's a number of quite lengthy publications out there which are quite granular. I think where we've tried to go here is being concise, just in being mindful of some of the discussion that we had at the workshop session around the excerpts which were included by and from other public documents, and taking into account some of the panel's comments on the respective length and content of some of those excerpts. What I would say is that those excerpts were that, as opposed to being the full document. So I don't know if that just helps give a little bit of context, but as I say, be pleased to share with you some public examples from other funds as to how they've documented their own approaches.
Thank you, Jennifer. I guess when we could look, I think Tamara mentioned it, like having an introduction might include a kind of summary sheet, or kind of page. That might, because I know we've. Because we want to include everything that we think is important, but I appreciate, it might read well if you have the summary that most people can look at, and then you take away the main messages rather than going into the detail. In terms of the stakeholders, I think that's something we can include as well in the if we agree to this, with something that we can include when we present this back at the next meeting. In terms of the stakeholders, that was kind of can be a vague term. I think tomorrow you mentioned, I agree, kind of going to the going to the board and going to the employers. So I don't know if that's all the employers, but I don't know if we need to be. If you give us an idea, I don't think we could stipulate exactly who it's going to be now, because it might be easier to get hold of some people than others. But if you want to give us an idea of who you mean by stakeholders, just so we're clear. Thank you.
So perhaps as an example, what we're doing in Sutton is we've gone to the board, and the board have endorsed the approach of then going to all the employers, and it's communicated via the sort of standard employer communication process, and aiming to reach as many members as possible directly via the pensions portal and via the council's own website for staff who are current active members. We agreed we couldn't proactively go and mail every single deferred member. That just wasn't feasible. But where we could reach people via websites, we would aim to do so.
Okay, and so that's so so that's the same approach we think we will be likely to take. I mean, I think that seems sensible, as you say. I think it's generally a good news thing to do. But good news message. So that will be probably the same. People will be contacting in this consultation, whether it's the board, the employers and employees as far as we can through the portal.
I'm not certain I know what Sutton, well, I don't know what Sutton's grouping is. I mean, do they have the same external employers as we do in terms of, the university? And
well, they don't have a university, so they don't have that one big one. The service provider partnership, the various scheduled and admitted bodies are comparable, but yes, the big one in Kingston is obviously the university.
I think we will definitely be contacting, I assume. Alison, any kind of follow up on that?
Nope. That seems like a good list. I'm just, as I say, it's that we're responsible for more than just RBK members, so that I just wanted to make sure that it, that this is disseminated, and that the university realise that they're supposed to then, make sure that it goes through their similar processes like RBK have.
Well, in terms of the members, I mean, we will be contacting. You're saying we contact the members of. Well, is it? So I guess that's the question. Who contacts the kind of employees? Is that us, or are you saying that? Well, I think you're saying that we contact the employees through the portal, and that will cover all employers, would it, or not necessarily? Sorry, Tamara.
So all employees who use the portal would see it via the portal. Obviously, we have no control over who in practice accesses the website and is an active sort of user of the portal. What I would say is the board should have a role to play here. I mean, they represent the employers and employees. So the chair of the board obviously is a Kingston University representative. So I would hope they could play a role in facilitating the consultation as well.
Well, that we could, good start. We could start working together, and hopefully they can get involved as well, because I think that's something obviously we've noted that we could improve upon. Okay, so yeah, I go back to the vote if we're happy to. So I mean, we talked about the in terms of the consultation, who will be kind of trying to reach, and it sounds like quite as many of the employees and the employers, as well as the board, and hopefully working with the board to kind of to make that successful consultation. And yeah, we talked about maybe having kind of an introduction or summary sheet of all the for the investment policy, well, so the responsible investment policy when we bring it back to group. So subject to those, subject to the kind of cost review and the consultation, are we happy to kind of agree to what's to this draft strategy? That is the question we'll be answering now. So Kevin, if we're all happy, Kevin, can you over to you, please?
Chair, I need to ask what the exact resolution is, because it seems to have grown quite substantially.
Well, it's about, so it's, I mean, we were just clarifying, so that we were just clarifying who would be the kind of stakeholders in the consultation. So it's still subject to a consultation. It's subject to, basically, this is going to be looked at by the officers, and Aon going to go away and just look at the kind of cost implication of the proposals in the responsible investment policy. So subject to that cost review, I guess, and the consultation. So still those 2 points. We just had some clarity on those. We will we agree to the this draft investment policy statement with the removals that we've already discussed. Is that okay, Kevin?
I'm just trying to make notes so I'm clear.
So yeah, so subject to having the kind of the cost review undertaken by the officers and Aon, and the consultation with the stakeholders as we discussed. Are we happy to approve the draft responsible investment policy with the kind of removal of the 3 points that we've covered?
Can I put that to the committee?
Yes, please. Yeah.
Officers, members of the committee, I'm asking you, subject to the changes that the chair has noted to the resolution, will you declare whether you're in favour of, against, or abstaining from this vote, from this resolution? Councillor Aurora.
Agreed, for, subject to the changes just noted. Thank you.
Councillor Bainan.
Yeah, agreed.
Councillor Goodship.
Agreed.
Councillor Ha.
I agree.
Councillor Holt.
Agreed.
Thank you. That's unanimous.
Well, thank you very much, Kevin. And so, yeah, well, thanks very much. Thank you very much, Jennifer, for your time and expertise. So, yeah, appreciate it. Thanks very much to everyone. I know this is that was quite a long item. We were nearly at the end, so I propose we carry on straight through to the end now. Thanks very much for sticking with me. And I know this is an important item. I know we're nearing a final kind of statement, and I think that's good, and it's important we get it right, and that everyone's happy, so everyone's along for the journey. So I appreciate everyone's feedback and questions. So moving swiftly on, we are nearly we are very near the end of the meeting. I think the next item is the amendment to the funding strategy statement for exit credits, and that's tomorrow. I think you're taking this point. Thank you.
Chair, would it be all right if I dropped off the call at this?
Oh, sorry.
Yeah,
Jennifer, absolutely. Feel free to leave. Yeah, thank you. Well, thanks very much, and
Thank you. And thanks everyone for your time. Much appreciated. Thank you.
Thank you, Jennifer. Bye bye now.
So the exit credit policy is hopefully a quick item. The regulations changed earlier this year, unfortunately, just after you approved the funding strategy statement. So we need to make some minor amendments to the funding strategy statement in order to incorporate the new framework for exit credits. So when an employer leaves the scheme, under certain very limited circumstances, they may be entitled to an exit credit if they're in surplus and they've participated in full risk sharing while they were a member of the scheme. The regulations are quite friendly to the administering authority in that they allow the authority to set out how they will determine if and whether and how much any exit credit might be. And the onus is on the employer to demonstrate that they are entitled to an exit credit. The authority is allowed to take into account any other factors when determining if an exit credit is payable. So the risks to the fund are fairly limited. The wording is proposed to be added on page 16 and 17. I won't read it out. It's there in the note. The issue that it does give rise to, however, is what would happen if an employer were to dispute our calculation of the exit credit. And currently, we don't have a dispute resolution process that really caters to employers. The current IDRP is for use by individuals disputing their individual pension payments. So we have developed a dispute resolution procedure which would be appropriate for employers, allowing for an external arbitration process ahead of final referral to the Pensions Ombudsman. This obviously needs to be agreed by both Sutton and Kingston, given it's a combined service, and the process would need to be identical for both boroughs. The procedure, I think, is fairly straightforward. In practice, we haven't had any cases yet. Neither we haven't had any cases, but also there's only been 1 or 2 cases nationally. So nobody really knows yet how much of an issue this is going to be. The actuaries have actually advised that we should probably reconsider this policy in a year or 2 and see what, if any, cases there have been in practice, and if we need to look more carefully at this. But at this stage, I don't believe it's worth spending a significant amount of time or money producing further detailed documentation on this, given we haven't got a live case and there isn't a live case in prospect. So I'd just propose that we add those additional lines in on page 16 and 17, as I've noted. The other point to note is that because this affects employers, we should probably consult with employers on this as well, but a much more kind of vanilla consultation. So for their information, we should circulate it to them as the revised funding strategy statement.
Okay, thank you, Tamara. Any questions or comments on the item? No. So I think we, yeah. So I think we just need to kind of. Well, I think we need to vote on this. Kevin, is it right, or can we this be noted? I think we need to vote.
Sorry, Councillor, I was battling to get my sound on. It appears that it's just a note item. It doesn't have to be something that requires a resolution. Okay, yeah.
Are we happy to note the item? Yeah. Is that okay? So was that question? Was that okay? Was that question, or agree that you note it? No, you're agreeing you note it, I think. Okay. All right. So I think that's, that item is noted. So thank you. Next item on the agenda is the training survey. again, I think it's tomorrow. This is regarding the recent, hopefully, we've received a couple of months ago now a training assessment online. If tomorrow, if you want to take this, give us an update on that and kind of what we can learn from it. Thank you.
So, as I'm sure you're all aware, the regulatory scrutiny on the level of skills and knowledge of pension committees and boards is ever increasing, and we are required to demonstrate that we keep everybody's skills and knowledge up to date. I would just emphasize that the focus is not on requiring every single individual to have every single piece of knowledge or every single skill. The requirement is that the board or committee as a whole has this appropriate skills and knowledge. So obviously individuals will bring different skills and knowledge from their other lives into this forum. So we are not looking to assess individuals, we're assessing the group as a whole. You should have all received the invitation to complete the assessment. I believe there's one or two still outstanding. So if anybody would be able to please complete the assessment if you haven't done so far. It is being kept open especially for us because they knew that our panel meeting was today. So you have another 2 days in which to complete it. And it's important that we do get everybody's completed forms, because the output of this assessment is supposed to be a training plan that highlights where we as a group collectively have skills gaps or knowledge gaps, and therefore we can then develop the training plan on the back of those skills gaps or knowledge gaps. So without everybody participating, that process obviously won't be as effective. So please, if you haven't filled it in, please do so. I realise it's quite a pedantic questionnaire. I have had a few comments about the it's kind of exam technique needed to answer the questions with double negatives and that sort of thing. Please, I do understand those concerns. Please bear with it. But I do think the actual content that it covers is quite a good guide to the sort of content that panel members do need to be on top of.
Yeah, thanks, Tamara. I think there's been, I think 4 out of the 5, I won't name and shame, 4 out of the 5 have completed the questionnaire. So one person to go, if they can do that in the next couple of days, please. And I'll remind the non-voting members also that Chris has left, the others who weren't here. I will remind, Mark Cooper's left the he's left the council and moved on, so we'll have a replacement for Unison who takes place. But I'll remind Leslie and Chris as well. All right, thank you very much. And yeah, we're moving on to the final, next item. I think the final item, the work. The work program. Again, it's tomorrow, I think.
Yeah. So this work program was actually drafted 2 or 3 weeks ago because we had to finalise the reports, and I think things in the interim we've realised how little time there is between this meeting and the next panel meeting at the beginning of September, and so I've been discussing with Daniel the investment strategy review process in particular, and I think we've agreed that it's probably going to have to go over 2 more meetings rather than completing everything at the next meeting. Is that your understanding too, Daniel?
Agreed. Yeah, I think it's sensible. We'll do an element of it, in the September one, and we've obviously got the December one as well. Yeah.
So that's the one change that I would highlight to you, that the investment strategy review is probably going to have to be split between the September and December meeting. Otherwise, I think
we're becoming quite a lot at the moment. Then we've got
a busy one.
Yeah.
Anyway.
Yeah. Sorry to talk over. Yeah, we've got quite a lot on. So obviously, this meeting's gone on quite long as well, and we've got other important decisions to make. Sorry, Rachel.
Sorry, just to note, obviously, coming on from our discussion on the responsible investment strategy earlier, that will need to come back to the next meeting as well, which obviously isn't reflected in the work programme as it stands, but based on earlier decision.
Yeah, I did. Absolutely, yes. Thank you. Thanks, Rachel, for doing that. But yes, ideally that will come back in the next meeting, assuming we have time. Hopefully, we'll have time to do what we need to do on that. And sorry, quickly, I need to just to cover basis. If we just go back about the training. Sorry, we're happy to note the training item, and that we are going to be completing the one person's going to complete the outstanding test, and then we're going to have that information back to enhance our training program going forward. So I presume we're happy to know that. Yeah, good, thank you. Sorry, Tamara, have you finished on the work program?
And just one more thing to mention is that the London Civ has had a large number of people appointed over the summer. So the new CIO, the new head of client relations, and the new head of responsible investment. I think it'd be too soon to try to get them to come and talk to us at the September meeting, but I would like to get them to the December meeting. So I think it'd be worth, particularly as at that stage, we'll be much clearer as to where we're going with the investment strategy. I think it'd be a good time to start a more sort of intensive dialogue with them about our investment needs going forward.
No, absolutely. Thank you, Tamara. Well, thanks very much for your patience, guys. Urgent items authorised by chair. None of those. We'd be glad to hear. Anyone any comments or anyone anything to add before we go? I know that was a long meeting. It's important that we obviously the responsible investment strategy took some time, and it's important we get that right. And I'm glad that we're not going to just getting it done for the sake of getting it done, and that we're making sure that we're all happy. That we're happy with the outcome. I will end the meeting there. It's 1:37. Thank you very much for bearing with me. We're trying to get the meeting times down. We will get there eventually, but there's lots of important things to discuss. So thanks very much, guys. Cheers. Have a lovely rest of the day, and we'll see you soon. Thank you.